Good evening to all the members who are joined for this virtual webinar on the topic of amendments to Schedule 3 and CARO 2020. So we have our past chairman, CA Jomon K. George, who will be the speaker for this session. And we also have CA Revati Raghunathan, a colleague in the Regional Council. I welcome the former chairman, my colleague Revati Madam, and all the members who have joined for this virtual seminar. And it's a great privilege that we have CA Jomon George, who has been a specialist in corporate laws and who has been addressing on this topic of amendments to Schedule 3 and CARO all across South India. So welcome to you, Jomon George, sir, for addressing the members. And I'm sure
thank you, sir. Thank you.
The members would be very keen to listen to you. Friends, the amendments to Schedule 3 and CARO are very important for us at this point of time, since the listed company audits are over, and we now have other companies to be filed before September. So I'm sure the changes in CARO and all the amendments, I'm sure Jomon George sir would be able to give a lot of clarity. And I would request all the members in terms of any doubts you have, any clarifications you want, I'm sure he would be very happy to share, and he'll be explaining all those issues very keenly and to your satisfaction. So I welcome Jomon George sir, and I request Revati Madam to introduce CA Jomon K. George before we request him to address the members. Over to you, Madam.
Yeah, thank you very much, Gilly sir. Good evening, CA Jomon, the past chairman of SIRC. It's a great pleasure to see you, meet you online today, and to be able to listen to your erudition on the Companies Act, Schedule 3 and CARO 2020. And good evening, Gilly sir. It's a great pleasure to actually introduce Jomon sir, who doesn't need any introduction, but for the sake of formality, here we go. He's been a fellow member of the Institute for almost 39 years, 29 years with diversified practice experience. And as we all know, he's been the chairman of the Southern India Regional Council of the CA Institute for 2019-20, where I was also a part of this team as a regional council member and the SICASA chairman. And he's a founder and managing partner of JVR and Associates, an 8-partner firm specializing in corporate audits and consultancy. He's a mentor. Philip Macmillan, who is a multidisciplinary accounting and a consulting firm based in Dubai. He's a faculty for auditing at the Institute of Chartered Accountants of India and has taught more than 10,000 CA students. And he's a regular resource person on the professional circuit on accounting and auditing standards and corporate audit. And he has done more than 800 presentations, and he's also a peer-reviewed trainer. He was a member of the Auditing and Assurance Standards Board of ICAI and was chairman of ICAI at Northern branch in 2002 and 3. He's traveled extensively in the UK, Middle East, and the Far East, and he's been a past president of the Rotary Kochi Central and a member of other various social clubs. Apart from being the honorary secretary of the Kerala Management Association, and he's also a member of the advisory board of St. Teresa's College, Ernakulam. With this, I present to you CA Jomon George, the former chairman of SIRC, who's going to address us on the Companies Act, Schedule 3 and CARO 2020. Over to you, sir.
Thank you so much. Good evening to all of you. My senior colleague, former colleague in the Regional Council, now serving as Secretary of SIRC, C. Naresh Chandra Gilli from Hyderabad, C. Revati Raghunathan from Chennai, who we had worked together for 6 long years in the Regional Council, and the other members of the Regional Council, if some of you are present there, very, very respected senior members, colleagues and friends. I'm extremely delighted to be with you this fine evening, online though. That has become the order of the day now. We are slowly getting out of the fear of COVID and started organizing physical meetings, but this is a larger platform, I understand, We have a good number of registrations, 800 plus online now with us and others joining in. So my compliments to SIRC for having a program like this. I would like to thank Chinnamasan Talakayala, the SIRC chairman, who is not there with us now. I think he's traveling, and that's what I heard from secretary. So thank you, Chinna, and the entire council for inviting me to SIRC to discuss on this very important topic, which is a current hot topic, as we can say, amendments which have come to Schedule 3 of the Companies Act dealing with financial statements. And of course, a very demanding, very challenging CARO 2020, where there are very onerous reporting responsibilities. So with this introduction, let me straight away get on to the topic by trying to share my slide.
Visible, sir. Can you navigate to PPT, sir? Yes.
Is it visible now? It's the full screen?
Yes, sir. Yes, sir. Full screen visible, sir.
Yeah, okay. So the new Schedule 3 or the amended Schedule 3 and CARO 2020, we'll start with the changes that has happened to Schedule 3 first and then move on to CARO. So Schedule 3, as we know, Chapter 9 of the Companies Act 2013. Before getting into that, let me also say that many of us are in corporate law practice, in corporate audits. Some of us are there very actively, some passively. Today, I would start with a request to the entire fraternity, my friends who are there, 863 as of now, to reinvent corporate law practice if it is not there, because many of our customary areas are disappearing and there's huge potential for corporate law practice blended with an IP practice. So it is very important that we familiarize with the provisions of the Companies Act 2013, advisory, compliance, company registration, company winding ups, wherever we have a huge role to play in making companies happen and the projects take off. So here it is Chapter 9 of the Companies Act, which talks about accounts of companies, Section 128 to 138. Of that, 129 discusses or deals with financial statements. In brief, it says that financial statements of companies should be in a format given in a Schedule 3 to the Companies Act 2013, the balance sheet and the profit and loss account. Cash flow, we have a separate reference from Accounting Standard 3. So that is how we deal with the financial statements. Major sweeping amendments have come in the Schedule 3, which is 3 divisions, as you know. Division 1 is where vast majority of our clients, small and medium practitioners, I presume that majority of the audience today or participants today are SMPs, and the financial statements of companies who are required to comply with accounting standard rules, who are not required to comply with Ind AS. Division 2 is Ind AS. Division 3 is NBFCs. Ind AS in brief is required for companies with listed companies, as Naresh ji rightly said, and of course companies, unlisted companies with net worth exceeding 250 crores. So majority of our clients are Division 1. Our presentation today will largely focus on the first column companies, that is companies accounting standards 2006 or unlisted companies with net worth of less than 250 crores. This is how the division is, and straight away we'll go into the item wise or changes that has happened. Now, the first thing that has happened is that the rounding off has been made mandatory. It was optional earlier. Now it actually reduces the punching time, the dot plus 2 decimals. In fact, that saves a lot of time. So if your total income is less than 100 crores, you must round it off to the nearest hundreds, thousands, lakhs or millions. And if it's more than 100 crores, no hundreds and thousands, it should be nearest lakhs, millions or crores. So this is a mandatory change which has happened, and therefore one has to essentially comply with that. Initially we may have a problem, but once it gets used to, we have to get rid of bye-bye data, bye-bye paise and small decimals, and we have to get rid of. So majority of our companies where the total income is less than 100 crores, we can round it off to the nearest hundreds, thousands, lakhs or millions. The second one is the face of the balance sheet. It's a change in the terminology. As we know that in the IFRS and Ind AS, the term fixed assets are not common, which we still call them fixed assets schedule and depreciation schedule. But here the term tangible assets have been replaced with property, plant and equipment. This is on the face of the balance sheet of the division 1 format of schedule 3. Is it going okay? Am I audible? Can somebody respond? Revati ma'am?
Yeah,
Are you
you're
there?
right. You're audible.
Pretty much audible.
Thank you.
Very much audible.
Thank you so much. Yeah. Now, so the first slide is on rounding off and the terminology change. Now, in share capital, they have brought in a new requirement. We are used to giving the details of shareholders holding more than 5%. In the, we don't call it the schedule now, in the notes on accounts below where we show the authorized capital, paid up capital and all that. Now here they're asking us to show the promoters, not asking us. There also we need to discuss. Why is that practicing chartered accountants are discussing schedule 3? Because schedule 3, in theoretically speaking, it is the property of the management. The financial statements are to be prepared by the management and given to the auditor for audit. This is what the law says. This is what actually should happen. But vast majority of us either prepare or help our clients in preparing the financial statements for 2 reasons. One is that they do not have the wherewithal. They do not have the expertise, machinery to prepare financial statements. Not only in compliance with, let alone the revised schedule 3, the basic requirements of the Companies Act, compliance with accounting standards, all those things. The average accountant in a small and medium company thinks that his job is over when there is something called a trial balance. Aging of debtors, creditors, now which is required, is the auditor's job. Inventory valuation is the auditor's job. Preparation of the financial statements is the auditor's job. Factually, it should not be so, but then in practical situation, we are all helping them. Therefore, we need to be familiar with schedule 3. Even if all our clients are able to prepare these financial statements and with a resolution saying that this is given for audit, etc., are able to give us, we still have to report in the main body of the report, not in CARO. The main body of the report, the auditor is required to say, state specifically, categorically, whether the financial statements comply with the requirements of the Companies Act in the manner so required. So this expertise is required for these 2 reasons. So therefore, promoters, number of shares held by each promoter, we'll see who a promoter is, percentage of total shares at the beginning of the year, at the end of the year, and the percentage of change. I had mailed across a format of schedule 3 in Excel, editable Excel format, and a CARO 2020 to my colleagues across the region, because I thought that some homework has been done in my office by our team. Everyone doesn't have to reinvent the wheel. Spend time on that. With the caveat, my covering note of the mail said there's a caveat that, okay, let's have the customization done. User discretion was highly recommended. Therefore, I think I hope that some of you would have received it and started using it. Nevertheless, we'll surely have that. And the PPTs were also shared, slightly different format. So this is a promoters holding, opening, closing, percentage of change, number of shares, etc. And who is a promoter? Who is mentioned, named as a promoter in the offer documents, who has control over the affairs of the company, directly or indirectly, in whose advice, directions, instructions, the board of directors, the company are accustomed to act, and does not apply to a person who is acting merely in a professional capacity. A chartered account acting as an independent director, I mean, of course, normally they do not hold shares, but then for the sake of definition, they are saying this. So promoters holding below that 5% of shareholding, we give a separate format to schedule, or rather a tabular form where we have to disclose this. Moving on, the current maturities of long-term borrowings are now categorized under short-term borrowings. Earlier, we used to show it under other current liabilities. So current liabilities here, this is short-term borrowings. I really do not know what the logic is, but here, when we prepare the CMF form of working capital assessment and things like that, installments of long-term borrowings or EMIs of long-term borrowings, which has already fallen due, plus what would fall due within 1 year, 12 months from the end of the balance sheet date, we show it as a current maturity, and that is how the working capital eligibility or the drawing power is determined. Now, why I'm referring to CMA and all that is, those who have read through, those who have tried to understand the spirit of the revised Schedule 3 and the CARO 2020, it's very evident that all these changes are primarily helping a banker or a financial institution who has given money to the companies, the corporates. Not without reason. Today, why is that banks have not shifted to, or rather banks are still not required to follow in days? The bank balance sheets are already weak. Lot of bad loans are not being reported. Today we have a bad loan bank also. The real extent of NPAs is much more than what is actually reported, which I think about a rough estimate of 13 lakh crores, which is huge, but the real figure could be more than double that. So therefore, we protecting the banker and saying that, okay, these are things which the auditor, that onerous responsibility is put on to the auditor. If the management is not moving righteous listening, then the auditor has to report on many of the aspects. There are common aspects in Schedule 3 and CARO, which helps the banker to clearly identify mismatches and misreporting. So here there's a classification from current liabilities. Current maturities of long-term borrowings are now to be shown under short-term borrowings, a structural change. So going back to the previous slides, once again, what is the practice note? Rounding off we can do, not much of an issue. On the face of the balance sheet, for the first time, we will change from tangible assets to PP. Then it's a copy paste for the other clients. So first balance sheet this year, 21-22 balance sheets, which we are in the process of making, cannot be a copy paste thing. Now 22-23 is not a copy paste year. In fact, in my office, I've asked the assistants and my partners, the first thing you should do when you open a client folder of 2021 to 21-22, the first thing you have to do is go and delete the auditor's report, because the CARO report is completely different, and there are also changes in the audit and auditor's rules. There are 2 new clauses which have come in, which had to be deleted. And Schedule 3 also, I said, delete the old one, subject to having a reference to the previous year figures. And when we talk about all these new reporting requirements under Schedule 3 for a 21-22 financial year, they apply with equal force, equally applicable to 2021 as well. Previous year figures also should be shown against each item. So moving on, so this is where promoters will disclose. This is a reclassification that we have to do. We will do it. Now look at this. Trade payables aging schedule also has to be. I had presented in many forums in Schedule 3 as well as CARO. 2 residential programs also. I think friends from Chengalpet, if you are there, Chengalpet and Pondicherry had organized joint program in Kerala, in Kumli hill stations, where it's really pleasant. It's raining, it's misty. It's good time to visit. And also in Munnar for the Coimbatore branch, where we had a lot of interaction. Said that the feeling now, if you look at trade payables, in addition to sundry debtors, which we call it as trade receivables, trade payables, capital work in progress, intangible assets under development, the aging details have to be given. So the thinking, rightfully to some extent, is that whatever is old is bad, not human beings. As far as figures in the balance sheet, in the financial statements are concerned, whatever is old is bad. So therefore, they want us to show trade payables due for payment and the aging schedule less than 1 year, and MSME and others. This is a huge challenge. Even the listed companies, there is no concerted effort to identify MSMEs, and MSMEs do not report to these people as MSMEs having claims under the Act for delayed payments and things like that. So there's the auditor, after making the basic inquiries and going to the only method of getting the information is by getting a detailed letter of representation. I'll come to that a little later. In the wake of the new CARO 2020, when we come to, we'll discuss this, a mandatory requirement. In fact, I had sent another mail with a format of a management representation letter, which is mandated by SA 580, written representations. Standards in auditing or auditing standards are mandatory under the Companies Act. We will come to that a little later. Now here the classifications, MSME and others, disputed, undisputed. All those things you have to show less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. And who is going to do this? Now I'm asking you a question. We have 1,000, we have crossed 1,000 attendees as of now with 1,000. That's good news. For the credit goes to the organizers for the efforts they've taken and also the importance of the topic. I'm fortunate to be a speaker addressing 1,000 members on a virtual platform. It's really nice that we are able to reach as many as possible when this kind of an exercise is being done. Now, how many of us have sent a mail? As SMPs, I'm saying, so the bigger firms have their own ways of dealing with clients. But how many of us have sent a mail to our clients where there's some kind of an accounting system, not very small clients, telling them that there are a lot of changes in the Schedule 3 format. Additional details are required to be kept ready. Or are we waiting for the audit to start and our audit assistants to do all this work? It should not be. We have, as a firm, we have sent to all our clients, each partner, the engagement partner, to their team of the list of clients we have sent them, saying that the additional requirements, and therefore these are the things which are to be kept ready in addition to what used to be there, along with the checklist for audit readiness we send them. This has really made a change, reduce the time in audit as well as reduce the time waiting for details in rounding up an audit. Time factor is very, very important, and we have a constraint on resources. Many of the firms have a lot of problems in getting the right manpower, the students, and a good number of students. We are largely a student-centric firm, very few staff, and majority of our team are articles. For that also, we have to create a healthy academic environment in the firms. The whole thing is changing. If the new amendments are going to come, articles will be reduced to 2 years. That's to be deliberated separately. So my point here is that we should alert the client, communicate with the client. Let there be a WhatsApp group, let there be a mail group with the client saying that, okay, these are the new things, be aware of that. Make a call, make a few calls. If you have younger partners, not the senior partner, let them call the client saying that there are a lot of changes. We have sent a mail, please respond or please be ready. So coming back to this, the action point here is that we have to do this reporting, MSMEs and others to the extent available. And then this is the new reporting requirement on trade payables, the complete aging. Property, plant and equipment, the first point is already there. A reconciliation of gross and net carrying amount of assets at the beginning of and end of the reporting period, showing additions, disposals, acquisitions through business combinations, amalgamations, etc. This is there. But look at the second bullet point, which is the amount of change due to revaluation. If the change is 10% or more in the aggregate net carrying value of each class property, plant and equipment, only if it is more than 10%, we have to show the amount of change due to revaluation. Other adjustment and related depreciation reversal shall be disclosed separately, separate disclosure. Even otherwise, even if it's less than 10%, if a revaluation has been done, to give effect to that revaluation, this has to be done. But here is a separate, more, I would say, pronounced disclosure requirement of the revaluation changes, which is more than 10% of net carrying value. Moving on. Security deposits again. Security deposits are omitted from long-term advances and it is now shown under other currencies. This is a cosmetic reclassification, I would say, that it is from long-term advances to other non-current assets. Utilization of borrowings. Where do we show this? Under the long-term borrowings, where a company has not used borrowings from banks, financial institutions for the specific purpose for which it was taken at the balance sheet date, the company shall disclose the details where they have been used. This is already there in CARO. CARO, it was there. Now, this is a reporting, or rather in the financial statements. Below the note on, or rather schedule as we call it, as we used to call it, now it is all notes. Below the long-term borrowings, if we are convinced, the auditor or the company, this company, but we are helping them, therefore we say that if that is no other use, then I say that all the above borrowings have been utilized for the purposes for which they have been taken and there are no diversion of funds. If there's diversion, this has to be quantified and disclosed in this. So this is a requirement under this thing. So the format is already there with you, or else you can surely, I mean, I'll be really happy to share the format, which is there on our website also for which I will share the web ID also. I hope the going is okay. If you have some comments, you can unmute and interrupt. I don't know whether you are muted fully. Anyway, or we'll surely have a Q&A towards the end of the session. The interaction would make it interesting and useful. Trade receivables, we were used to exceeding 6 months and other debts, but today we are now having less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and the total. Undisputed, considered good. Undisputed, considered doubtful. Disputed, considered good. Disputed, considered doubtful. So there is a cross tabulation which is required. One is age-wise, one is between disputed, considered good, and considered doubtful. This we are used to, so I think we'll move faster. Now, title deeds of immovable property not held in the name of the company. This is already there in CARO 2016. We continue to have that in CARO 2020 as well. But then here, the financial statements in the Schedule 3, below the immovable property. So wherever there's no issue, we have added a new line below the schedule of property, plant and equipment. In office, all of us still call it FA schedule. Is it not? Financial, fixed asset schedule, FA and depreciation schedule. Below that, we give a note saying that all the immovable properties listed above are in the name of the company. We have to making sure. But we have had situations where, in fact, there's a lot of discussion on this. Can there be immovable property in the balance sheet of a company which is not in the name of the company? So somebody said possible. Earlier we had, Part 9 conversion under the Companies Act, where the firm would be, the assets of the firm would be vested in the name of the company. There will not be a mutation at the village office. When Kerala, the scene is that, the mutation for a property to become that of the company, the mutation has to be there, and in the village records, it has to be converted, and tax has to be paid in the name of the company. Only then it becomes eligible to be shown in the balance sheet of the company. But there could be exceptional situations. One has to take it with a pinch of salt. There has been a lot of malpractice in this area for the sake of bringing in capital adequacy, etc., etc. By just passing an entry, land account debtor to director's current account, or share money advance and allotting shares. It's a very common practice in the Middle East, I have seen. Even because there that mutation and conveyancing is not very mandatory for all. The bankers are happy, so the auditors also say that this is perfectly fine. But our case here is slightly different. When this came into CARO first, I thought, is there a requirement to have this? But a little later, we were appointed by the official liquidator, the High Court of Kerala, to do an investigation into a company, where we found that 18 of the high-value properties which were finding a place in the balance sheet of the company were registered in the name of the managing director, his wife, or his son, without even the company's name for the address sake. But that was happily audited and filed. So therefore, there's a feeling that this has to be very clearly emphasized upon, ensured a reporting requirement when it is there. We would look into, at least call for a copy or the original of the title deeds or the sale deeds, as we call it. Here in the schedule below the balance sheet, if there are not in the name of the company, look at the details we have to give, whether they are property, plant and equipment, investment property, BP, property, plant and equipment, retired, active use and held for disposal. Land building, gross carrying value, title deeds held in the name of. If it is not in the name of the company, who's its name? Jomon K. George, managing director. Okay. Whether title deed holder is a promoter, director, or related, that becomes all the more, a problem situation where how that related parties or promoters that is being shown in the balance sheet. Since which date it is being held, and there are disputes, if any, you have to show, and reason for not holding in the name of the company. Is there a legal restriction? Is there a, though the beneficial ownership may be with the company, why is that the legal ownership is not being able to be held in the name of the company? We have to give. Revaluation of property, plant and equipment, whether based on if there is a revaluation, it cannot be done by XYZ. It has to be based on the valuation done by a registered valuer. That has to be given specifically. That is again relating to property, plant and equipment. The next point is relating to loans and advances, either current or long term. If they're given in the nature of loans to promoters, directors, key managerial personnel, and the related parties, then we have to show the full details of that, either whether they are repayable on demand without specifying any terms or period of repayment. It's possible. It's possible that there could be a loan given to a director or a director's wife. One has to be careful from a tax point of view also. 222E, which deals with deemed dividend. I'm not a tax person, but many of the cases we have had notices from the department, from the notes on accounts. They would just glance through the related party transactions, and if there is any debt balance in the name of a director or relative, then they used to send notices saying that is 222E taxable as deemed dividend. To the extent that the company has profits or accumulated reserves. It's a loss-making company, there's no issue. There is no tax incidence. That's why people very often say that it's easier to siphon funds out of a loss-making company than a profit-making company. Okay, so therefore, type of borrower, amount of loan outstanding, percentage of total loan outstanding, etc., has to be given. And just yeah. So these details also have to be given under the loans and advances. The new requirement is regarding and what's the total percentage to the total loans and advances. For example, the 10 crores of L&A loans and advances, 2 crores is that given to the key managerial personnel, promoters, directors, etc. Then it is 20%. Like that, you have to compute and do that. Capital work in progress and intangible under development. Look at this. We have seen in many cases property, some of the capital, the construction, whether it is a building under construction, a machinery under erection, or some development, could have been held up for various reasons. Financial constraints. While talking about that today, financial constraints, there's a new term which is evolved. I don't know whether some of you would have noticed that in the startup space, there's going to be a funding window. Fundings are stopping. Investors and PEs are backing out from the promises. There's a shake-up all over the world. Elon Musk was the first one to say that the outlook is gloomy bad, and he started retrenching people. And with that, there is a gloom. Capital markets outlook is not very good, at least in the short term. The war issues, all those things are happening, and therefore the COVID in China blocking shipments. So there are going to be some more major issues and economic growth. But India still seems to be a bright spot with the even revised growth rate of 6.3%, as against 8.2 in the earlier assessments. So anyway, that was incidental. So it could be there that for fund constraints it can get stopped. Government license issues, ecological issues, all those things that can happen. Therefore, if it's kind of stuck in debt, then what is the whole point in carrying it as a fixed assets, or which would eventually get converted into fixed assets, a capital work in progress. So therefore, that's very important that we show this. That's what I said. If it's too old, it's bad. Less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Projects in progress, projects temporarily suspended. The total shall tally with capital work in progress amount in the balance sheet. Goes without saying. Goes without saying. Same is the case with intangible assets under development. In the case of startups, incidentally, startup advisory is also an emerging area. Initially, there may not be much quite lucrative, but if some of them blossom, experts like Chris Gopalakrishnan once mentioned that only 10% of these young boys and girls who come up with startup ideas blossom. And we have startup unicorns now. I'm sure you know what a unicorn is, who has a valuation of 1 billion US, which is about 7,800 crores of Indian rupees. They get valuations of that sort. In fact, in Kerala, we have a unicorn startup in which there's a chartered accountant, Dina Jacob. They're based in Bangalore. So startup phase is good for advisory. They need a lot of help from us. Everything may not be chargeable. If they blossom forth in funding and all that, there is an opportunity for chartered. We have the last 2 years developed a separate vertical called startup advisory, getting them registered with the ministry, insulation from angel tax, insulation from tax on perquisites when security shares allotted, HEIAB, if I remember correctly, which has been extended 1 year up to March 2023 in the 22 budget by Madam Nirmala Sitharaman. So incidentally, I was saying this, the startups, when they get going, they will add up all the revenue expense they have incurred as they tend to capitalize. They will not debit into the P&L account. They say that these are intangible under development. They're looking at developing a product or a concept which would one day blossom and become commercially viable and then explode in value. Think about Tally in its early days. If Tally package had taken 3 years for development, looking back now, it would have been very sensible to continue to capitalize all the expenditure that I incurred, the salaries, the research work, all those things they incurred, the depreciation on the laptop, all those things would have been worth the capitalization. But here, indefinitely going on, showing it as under development, there is now a requirement to show the aging less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years to be completed. That's how they are giving. It's not strictly in the sense of it's not aging. This is talking about what is the plan on this intangible under development. Project 1, 2, it may not be in one single project. Project wise, you'll have to give. Benami transactions, if there are proceedings initiated against a company or the company is holding any Benami property, under the Benami Transactions Prohibition Act, entire details will have to be given in the financial statements. And if the property is not in the books, that becomes even more difficult. Property is not in the books, then the fact shall be stated with reasons. That will have to be going into the notes on accounts in general. Otherwise, if there are no issues, what we are doing here or started doing here is that we will show that there are no proceedings pending or initiated against the company under the Benami Transactions Prohibition Act 1988 below the asset schedule. We will show that, or PP schedule will give a note in future. Property is not in the books, the entire details have to be given, and the details of the proceedings have to be given. Now, this is again there in CARO. They are brought in. This is working capital facilities drawn, and then they're supposed to file quarterly returns, right? So enhanced disclosure for borrowings from banks and financial institutions on the basis of security of current assets. So you have an ODCC. The bankers insist that you file a quarterly return or quarterly statement of current assets, mostly inventories and receivables. Now, it is a very clear fact that there are non-existent inventories, absolutely unrealizable amount of huge amount of trade receivables lying in the balance sheet of many of the constituents. This is a concern for the banker. So this is again from a banker's angle that the company in the first place is asked to report whether quarterly returns or statements of current assets filed by the company with the banks and financial institutions are in agreement with the books of the company. If not, the summary of reconciliation and reasons of material discrepancy is there. Here, this has to be shown irrespective of the amount which is outstanding. But in CARO, only if there's a working capital facility of 5 crores or more. We'll come to that a little later. This has to be given. So we had interesting questions during our interaction. In fact, my interaction, I think this is my probably 10th or 11th presentation on Schedule 3 and CARO, where people ask this question, sir, where will we get to the quarterly returns? I said the company is supposed to maintain quarterly return, whatever you file with an outsider as a banker, whatever you're supposed to have a copy. If it is not there, you should ask through the client, get it from the bank and see where it is there. And then the next question is that, sir, where do we find the stock? Where do we find receivables? I said, receivables should normally be available if the quarter end trial balance, the quarter end list of debtors, if you take, you can find out. But inventories, our experience has been, many of us would agree that medium-sized clients do not have really reliable inventory records. So there could be some round off here and there. And even when Tally inventory module is activated, we see negative stocks in many of the book stock. So unless there's a physical verification report, it becomes difficult. And books here, it's not with reference to physical verification, books of accounts. So this is becoming a very tricky situation, and one may have to qualify. Day before yesterday, I finalized an audit where we have a client who was borrowing off, but then as on 31st March 2022, the OD account is showing a plus. And since they have been servicing the working capital facility very promptly, interest and always within the drawing limits, good turnover, no other bank account and all that. So the banker is very happy. Banker has never asked for this quarterly returns. They have not filed. We double checked and this is a reliable client. We had an external source to confirm. We confirmed that, and finally in this requirement, we said that we asked a company, they also the corporate accountant is also there. He said the company was not asked, the company was not required, rather not filed quarterly returns with the bankers, bar financial institutions. That not be entered this. But whether it has been filed, the key question is, are you misrepresenting? When you have no stock, are you showing 2-3 crores of stock? When you're not receivables, it's not being shown at inflated figures. All those things is what is required to be given here. So this is a reporting requirement. One has to really be careful. And come to CARO also, we'll continue to discuss. Whether the company is declared a willful defaulter by any bank or financial institution. Okay. Here, in addition to whatever we would discuss, probably interact and kind of get information on, the institute has come out with guidance note. There are 3 volumes. In fact, in one of my slides, I mentioned that. The Schedule 3 amended Division 1, Division 2, Division 3. They are separate. Since I was not waiting for that. Now, non-India Schedule 3. See, look at this. I know whether this is visible there. This is the book which I've got it bound. Took a printout and got it done. But it's available. You can go to the CDS and buy this guidance notes. Very useful. In fact, when you come to the ratios, I have discussed a point where it was really useful. So here is who is defaulter, willful defaulter? They're making a reference to the RBI circular. Willful defaulter is one who has the wherewithal, who has the resources, but saying that, adamantly saying that, no, I will not pay. Like Manoharan sir recently said, some people say that it is against my principle to pay the interest. Against my principle to pay the interest. Some others say that it is against my interest to pay the principal. So both the principal and the interest are in default. And also that there has been diversion. Willful defaulter is where he will take a loan showing some project report, a fake project report, and divert the funds into some other. It could be to working capital, it could be to real estate. It's very common. So if you're willful defaulter, yes, also you can make a reference to the banker and make sure that if he's declared, if the company is declared a willful defaulter, then the date of declaration and the full details of the default has to be given in the financial statements. We are still in Schedule 3, primarily the responsibility of the management. Since all of us are helping them, some of us are preparing financial statements for the clients, we are familiarizing. Also because as auditors, we have to ensure that 129, section 129, from whom we through which we travel to Schedule 3 are duly complied with. This is auditor's responsibility as well. Now, details of transactions with struck off companies under 248 and 560 of the 1956 Act. If there have been transactions, outstandings, all those things. Now, is it required to scan through all the, see if there are regular ongoing transactions, all the debtors, creditors. Day before yesterday, we have a medium-sized client, and since I was back some free time, so the tally data the client is sharing now. Data is flying around. There's no data security, so they shared with the audit assistants, and she came here. I said, okay, let me scan through the ledger. We call it ledger scrutiny. I'm not doing this for many years. I said I will just reinvent all those things, get back a little bit into that since I'm less busy with the institute work now. So then we just scan through, and it could be complete in about 1.5 hours, the entire ledger scrutiny, transactions which are there. So coming back to this particular point of struck off companies, either one-off transactions, long outstanding opening balances not moving, and then such cases, using this thing, you can go to the MCA website and then check whether they have been struck off or not. So this is not required to be done in respect of. Of course, we will get a letter of representation from management or management representation letter. but we have to do our share of verifications, the substantive procedures, as they're technically called. And therefore, the name of the stock-off company, nature of transactions, so that's investment, receivables from them, payables from out of purchases or availing of services, shares held by stock-off company in our company, other outstanding balances, balance outstanding, and relationship with stock-off company. If it is there, it has to be reported. Otherwise, in the notes, we will say that the company did not have any transaction with stock-off companies and no balances outstanding from such companies. This is relating again, look at from the banker's angle. I am forced to reiterate the requirement. In whose interest that a charge has to be registered? It is in the interest of the lender. The reasons you know better. Therefore, now we have, I think we have 120 days to register a charge. After that, of course, there will be late fee, but after that, it cannot be registered at all. CHG1, form CHG1 is a form which we use for registration of charges, and CHG4 is the one we do for satisfaction of charge. So therefore, for that, we have only 30 days for satisfaction to be reported. Here, the requirement is whether any of the charges or satisfaction are yet to be registered with the ROC beyond the statutory period. The details are to be given again by the company. The next item is not related to charges, because for the sake of reducing the number of slides, some of the items are in a mixed up form. Now, this is layer of investments. Layer of investments, if you read 2 subsection 87, the applicable rules as well. In a holding subsidiary chain, you can have only 2 levels. A company can have B as a subsidiary and C as B subsidiary. So A is a parent holding company, its subsidiary is B, and C is you cannot have a D as a subsidiary of C. Only 2 layers are allowed. But in between, if you have, like for example, if B is 100% subsidiary of A, then you can go one layer down, C and D, because B will not be counted being a 100% subsidiary. C could be a 60% subsidiary of B. D could be a 52% subsidiary of C, and so on. But there it stops. Other than that, not more than 2 layers. So if therefore you're either a holding or a subsidiary, you have to show whether, no, this in the case of a holding company, whether this is more than 2 layers of subsidiary investments are held. Now, this is a new thing, all new thing, that whole lot of ratios have to be given in the financial statements. Ratios with explanation for items included in the numerator and denominator. Reasons for 25% or more variance compared to the previous year. Current ratio, debt equity ratio, debt service coverage ratio, where there are long-term loans to be repaid. Return on equity ratio, inventory turnover ratio, trade receivables turnover ratio. This is where I mentioned last week when we were finalizing an audit. This is a resort in Munnar where they have some payments coming in advance from travel agents. Food is being sold. Food is not part of the booking package, so food is extra. Food is being billed on cash basis. But at some point, every point of time, there is some kind of a receivable. And here, in earlier days, we used to think that trade receivables turnover ratio or debtors turnover ratio was sundry debtors divided by credit sales. But it is not so. Here it is, they say that total credit sales divided by average outstanding of trade receivables as a formula. It's all given in the guidance note. You can Google up and see. And so in the guidance note, or you can download. So in fact, I was so happy to see an audit assistant who was in the 3rd year of his articles, who was come back after his exams. And then he was parallelly, while preparing the financial statements, parallelly having the guidance note with him. So I said, we have a problem of arriving at the average receivables and debtors. He says that there is a guidance note says that if that is very difficult to assess or determine, then it is fair enough you say that total sales by closing outstanding of debtors is enough. And you have to give in the columnar form, if you see, you have to give like we do for earnings per share as mandated by AS 20. You have to say what is the denominator and what is the numerator. Fair enough. Same is the case with trade payables turnover ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment. All these ratios have to be disclosed in the notes on accounts. And if the variance from previous year, either up or down, higher or lesser, has to be explained. In the remarks column, you have to see how that is this year. For example, debt equity ratio can go down substantially when there is huge repayment of debt. And when do we repay debt? When we have good profits. So when you have profits, the reserves will build up. So debt equity ratio naturally will go down when debt reduces and equity, that is capital plus reserves, increase. So you say that the variance is due to repayment of debt as well as the substantial profits made during the year. We do not say substantial, the profits made during the year. That's how we give the narration and discharge the reporting this thing. And all these ratios, there is guidance note, and specifically all the ratios are explained in there. This is again in the case of amalgamations and mergers and all that. One has to make a reference to the scheme of amalgamation and make sure that the provisions of the Companies Act, the scheme of amalgamation has to be referred. This doesn't happen every day, but business combinations, as they have come to be called, become very common. And therefore, you have to also see the compliance with accounting standard 14, which deals with accounting for amalgamations. That is the pooling of interest method and the purchase method and so on. You have to make sure that they have complied. This again a new item, which is, I was giving this example that ours is a company sitting in India, or a company registered in India. It could be in Kerala, Andhra Pradesh, Telangana, Tamil Nadu, Pondicherry, Karnataka, wherever. And this company is getting some funds from, let's say, UAE. The company is getting a few crores of whatever, respective the amount, getting some amount into this company with an instruction that you pay this amount to another company or entity or a person in Sri Lanka. Sri Lanka needs a lot of money now. They are in deep trouble. The entire economy is in shambles, and a rough estimate shows that 67 billion US is what's required as a breather for the economy to put back on track. They took a lot of wrong measures, including agriculture productivity had gone down very dismally gone down because of the huge shift to organic alone. The commercial, lot of issues, you know better. So this is I just giving an example. UAE to India, India to Sri Lanka, and this client company of ours in India is just an intermediary. The other one is called the initiator. The UAE company is called the initiator, who initiates the transaction, and then we are used as an intermediary to transfer fund to a Sri Lankan company. It's just a hypothetical example. It's called the ultimate beneficiary. So this company is being used as a conduit, a connecting link for some kind of a money laundering transaction, because this link between Dubai and Sri Lanka, or UAE and Sri Lanka, they don't want to disclose. So therefore, this is being used. So in the balance sheet of our companies, if there's a stray receipt of funds and a similar stray investment or a debit balance in the form of another company, need not be overseas, it could be within India also. This has to be seen with suspicion, and then the company has to disclose the full details, dates and the amount of fund advanced, loan invested, etc., full details of the intermediary, of each intermediary, and all the ultimate beneficiaries, date and amount of guarantee they've given, and declaration that relevant companies have been complied with in these transactions and not violative of PML, Prevention of Money Laundering Act. This is a new reporting requirement. Same reporting requirement is there, not in CARO. CARO they have not brought in. They have amended Rule 11 of the Audit and Auditors Rules. We will come to that towards the end of the presentation. P&L, yes, the term, very few changes. The term total revenue has been replaced with total income. I hope the slides are readable. And revenue from operations, in the case of Section 8 companies, they have added a new head called grants or donations received. The second one is something which is relating to tax assessments, either under SIRC or as we call it, the income tax rate, or in regular assessment also. If transactions not recorded in the books of accounts have been surrendered and disclosed as income during the year in tax assessments, then the full details of that has to be given, and whether this previously unrecorded income and related assets have been properly recorded in the books of accounts during the year. None of our clients have had income tax search or huge demand on regular assessment as well. But then I was sharing just where we had interaction with some of the branches. I just asked this question: can we give a situation or a real situation? So we are trying to discuss like this. It was possible earlier. Now it is all the more difficult. In a search, everything is fine except that fixed deposit of 2 crores, FD receipt of 2 crores in the name of the company was found. Now, it is not in the books of accounts. So naturally, once that is detected, it has to be brought into the books of accounts. Otherwise, true and fair is not there. So previously concealed income or some kind of unaccounted amount, as we call it, black money has been generated and somehow routed and put in a, say, cooperative bank or somewhere where the KFC checks are. Earlier, it used to be big. Now they are also under the lens. We have a cooperative ministry now. So with all that, this is there. So how do we bring it to the books of accounts? So the response was that debit fixed deposits, 2 crores. There is a provision for taxation which you have to pay. That is one. If you take for ease of calculation 60%, provision for taxation 1.2, and the balance 80 lakhs is to be credited to revenue. This is how the suggestion came in. So if the question before this thing is, if it is not accounted, also you have to mention. And this is a way we should account. So ideally, it is recommended that if such a demand or additional detection of concealed income or assets have happened, it has to be accounted for. And here, unless there is immunity for disclosure under 11 of any scheme and also state whether previously unrecorded income have been properly recorded. If it is not recorded, we have to mention that it is not recorded, properly quantifying it. Now, statement of profit and loss. See, CSR, the huge lot of requirements. If the company is required under 135, CSR is mandatory under the Companies Act for them. Whole lot of details they have to give, amount required to be spent during the year, required to be spent, which is the 2% of the average profits of the previous 3 years, etc. The amount of expenditure actually incurred, the difference naturally the shortfall. See, 135 came in as a very friendly section, but today it's being very strongly enforced. And since it's a listed company, I can share a Federal Bank 2 years back. It's a Kerala-based bank, the Federal Bank Limited, which is a lot of branches across the southern region. Outside also, they had a shortage of spending, and MCA had reprimanded. And when that happens, they are to put it in the board's report, which is really shaming the corporates, particularly a banking company, of the reputation of Federal Bank. So say that we were supposed to spend 50 crores, we spent only 40 crores. That is earlier, and the 10 crores. So we have been reprimanded by the Ministry of Corporate Affairs, etc. But today there are penal provisions, and the unspent amount has to be accounted for. I think 2 days back, last Sunday, SIRC we had a session on corporate social responsibility and CSR and auditors' responsibilities. Because auditors to make sure that the company has provided for the unspent amount. And if you look at 135(5), subsection 5 and subsection 6, there are provisions to the extent that it has to be transferred to the government account, like IEPF, come back. Because the CARO point, we'll come to that a little later. And also saying that, we have to have park it in a separate bank account if there's unspent amount. A differentiation has been made that between ongoing projects, other than ongoing projects. We'll see that a little later. Total previous year's shortfall. Reason for shortfall, nature of CSR activities, details of related party transactions because you're contributing to a trust controlled by the company. Then that has to be separately given. Where a provision is made with respect to liability incurred, the movement in provision during the year should be shown separate. These are the whole lot of details to be shown. Whole lot of crypto valuations have also gone down now with the market crash in the scene. Where the company has traded or invested in cryptocurrency or virtual currency during the financial year, the following shall be disclosed. Profit or loss on transactions involving cryptocurrency. The Union Budget Finance Act 2222 is going to tax crypto. Then everyone said that, oh my God, thank God, crypto has been made legal. So Madam Finance Minister said, no way. Because we are taxing doesn't mean that we are legalizing it. And there's 30% flat tax on crypto transactions. It's a Budget 2022 proposal. So this will be the amount of currency held as on the reporting date. Deposits advances from any person for the purpose of trading, investing, cryptocurrency and virtual currency. They're called, now the term they've used for the income tax purposes, virtual digital assets, if I remember correctly, VDA. Now, those who have been watching IPL, before we go in, I think we are kind of done with Schedule 3. So before we go into CARO, let's take a detour. And I bring you some interesting math, which is in from IPL. This time, those who are watching IPL, Gujarat won. Rajasthan was the runner-up or whatever. Then there were 79 matches, league matches, totally 79 matches during this IPL season. And if you see the advertisements, majority of the advertisements were of gaming companies, crypto exchanges, etc. Right? And one which was there quite prominently was Dream 11. They featured Bumrah, Rishabh Pant, all of them. And they said, dream big, dream 11. A cousin, my brother-in-law, my cousin's husband was undergoing a treatment in Amrita Hospital in Kochi. So I just used to go and spend some time with him. So he is an IPL addict, knows every player in every team, he would say that. So he was showing me, he had logged into this Dream 11 platform. Particular day, I think he all you needed was 49 rupees to log in to be part of the gaming. And that day, the number of logins were 92,48,000. So ease of calculation, if you take 49 as 50 and 92 lakhs is 1 crore, the gross revenue, cash revenue of Dream 11 for that single day, one vertical of one match. In that, this bet could only be for who will win the match. There are other verticals like who will be the top scorer, who will hit maximum sixes, who will pick the maximum number of wickets. All those things are there. And higher entry fees is also there. This particular vertical is, they take it as 45 crores. It's 92 lakhs only, 49 rupees. So just a minute, 92 lakhs 48,000 into 49 makes it 45 crores 31,000. And the prize money that day paid out was 32 crores. So there's a net profit of 13 crores from this particular the vertical. It's quite striking. Now, what would be the valuation? They are into pro volley, they are into pro kabaddi. And who is the happiest? I think the government should be very happy that 32 crores paid out as casual income will have a 30% TDS. So the next morning, the finance ministry should be happy that is 10 crores of TDS collected and deposited, if it's deposited on the same day, or wait till 7th of the next month or whatever. And that's the kind of money that's coming into the kitty. So this is interesting math on the IPL and Dream 11. I was just thought I'll just share with you. So, my dear colleagues, these are the reporting requirements which a company has to do as far as Schedule 3 is concerned. Very demanding. This is a year of change, year of transformation, where one has to spend some extra time on learning and understanding, equally for applying these changes, and some help is there with you. I think the formats which I had sent, or probably downloads are available today. You could use that, and probably Before going into CARO 2020, we can take a few questions if it is there. Selva, can the participants unmute and speak, or how was it done?
No, sir. Actually, since it's
Selva, are you there?
webcast, audience who have joined in application might unmute and speak. That we need to give them the rights. I have compiled some questions, so can we take it up, or else we'll try audience to unmute.
Yeah, if we can display on the screen, that will be better, because let's
Yeah,
not
do
delay
you want to take it up now,
further.
sir, or
CARO
else
may
later,
take
sir?
another 45 minutes. I think we would take it. If Revati ma'am is there, I would take her consent also. I think it's better. Schedule 3 questions we'll try to answer now. You can display on the screen.
No, I'll just display it on the screen, sir. You just see the relevant question and you will take it up. So I'll just share it on screen. 1 minute.
I have to stop sharing my screen.
Yes, 1 minute. I'll take the rights. I'll take the rights. If you stop the screen sharing, I'll take the rights.
I have to stop screen sharing.
Stop now, sir. I'm sharing my screen. You can see my screen, sir.
Let me see. No, I think I've my screen is stopped. 1 minute. Is my screen visible now? Still no.
No,
Okay.
your screen is not visible to us, sir. Only my screen and your video is visible.
Aha, I can see the questions now.
Yeah.
Yeah. Question question 1. Whether the aging schedule is replacement to the disclosure of what given in earlier years, or this is in addition to what we used to disclose in earlier. So this is a replacement. So there is no need for disclosing that more than 6 months and less than 6 months. Previous year also, we have to bring it to the new format of aging of receivables and payables in the format which is required. That is less than 6 months, 6 months to 1 year, etc. So it's a replacement. It is not additional. On the face of the balance sheet, trade payable need to be disclosed as total outstanding dues of creditors, micro, small, and medium enterprises, and total outstanding dues of other than micro, small, and medium enterprises. Now my question is, trade payable aging need to be disclosed for MSME and other than MSME. Generally, MSME means micro, small, and medium enterprises. Based on the above definition, the amounts disclosed on the face of the balance sheet may not match. No, sir, on the face of the balance sheet, we'll give only the total of trade payables. It is in the notes, or rather earlier we used to call them schedules. It's in the note of trade payables that we give the breakup. And the total only will take it to the balance sheet. So there is no question of a mismatch there. Is the table payables is rounded off, or all figures to be given? All rounded off, sir. All rounded off. Rounding off is mandatory now. Not only in the face of the balance sheet and P&L, in the notes as well, in the schedules also. Should the corresponding figures changes to be made in 2021? Yes, I think you joined in late. I did mention that the previous year figures, and we always give a note at the end of the notes on accounts. Previous year's figures have been regrouped, recast, but this is mandatory. Previous year should also be recast and disclosed, all these disclosures. Can you clarify whether trade payables aging is applicable to companies for which Ind AS is applicable, or all companies? All companies, sir. This what I'm discussing now is non-Ind AS companies. First few of my slides, if you had seen, it talks about this is my presentation so far is purely on Ind AS non-Ind AS companies, smaller companies with unlisted companies with net worth of less than 250 crores. Sir, corresponding figure of trade payables need to be classified? Yes. Selva, you can go down. What is to be considered as a disputed trade receivable? But the dispute with the customer is lying in a court of law, only to be classified as general dispute. All disputes, sir, need not go to the court level. If there is a dispute on quality, there has been a return of some goods, etc., etc. You need not have to have a legal color to say that it is dispute. The client is refusing to pay, or they are asking for a huge discount or whatever. That's also would be shown as this thing. Sorry, general dispute with customer on certification invoice can be classified as NCS. As per Schedule 3 on the face of the balance sheet and in notes, we required to disclose trade payables as, no, it's on the face of the balance sheet. It's not required, so it's not required to be shown. Sir, dear sir, the aging schedule promoter capital promoter shareholding applicable only to listed companies, even to private companies. All companies are all companies. Advances cover trade advances which remain outstanding for more than a reasonable period or unattended for a long time. Naturally, yes, sir, it will be included. Sir, if there is no requirement substitution of quarterly returns as per the loan sanction for working capital, what disclosure should we provide? I did mention that in client's case. So you can say give a note under the working capital loans. Very rarely it happens. The client is such a good client. Their track record is so good. The banker may not bother to ask them to file quarterly returns. But from an RBI directive point of view, from a head office directive point of view, I have a feeling that this is a mandatory requirement for their security and safety if they would ask. But if they have not asked, you put a note and finished off saying that the company was not required to file quarterly returns and hence has not filed any quarterly. But make doubly sure. Don't just take the word of the accountant for granted. Make doubly sure that that is the real situation. Maybe hold on. Okay. Discrepancies in quarterly returns and statements need to be disclosed in the financial statements and CARO. Please provide some examples of what type of discrepancies need to be disclosed. Sir, you have given, let us say, quarterly quarter ended 31st December 2021. Third quarter end, you have given a stock statement to the bank, quarterly return. Inventories 2 crores, receivables 1 crore. When you take the trial balance as on 31/3/21, you find that the receivables are only 20 lakhs. So there is an 80 lakhs overstatement for the, say, because the banker would determine your drawing power based on that. That's a discrepancy which you have to highlight and say with reasons. You have to have the threadbare discussion with the management, or you have to say that we are still in Schedule 3. It is a management's property, but the auditor is helping them. I understand. We are on the same page. There, another one is inventory. Inventory records are not available. Some kind of a ballpark figure they have given in the bank and saying that 2 crores is our inventory. Where is inventory? Is there inventory records are there? Was a physical verification done? All those things you have to see. So discrepancies have to be, these are a few examples which I thought would be relevant. Willful defaulters list will not be available at public domain. Willful defaulter will not be available at public domain. How do we comment on the same? If there is a doubt, you can easily communicate with the banker. The banker would share it with you. There is no prohibition. There is no confidentiality breach. You can first primarily ask the company and then also there. And even after that, get an extra note in the letter of representation. I had mailed across a letter of representation format a couple of, maybe a week back. Hope you have received it. Otherwise, I'll give you the format, the reference to the Selva, please hold on because I'm not able to go. Yeah, okay, willful. Do we have any source to get overall list of stuck-off companies? I'm not too sure. But on a case-to-case basis, SIN-based search you can do. Corporate identification number-based search you can do on the MCA website, mca.gov.in. Do we need to disclose transactions with any other entity, non-company which had ceased to do business? Not as per Schedule 3. If it is ceased to do business and there is transactions, no, I mean, I understand. It's only for stuck-off companies. Whether new amendments in Schedule 3 is applicable to small company. Yes, sir. Schedule 3 is applicable to small company. CARO 2020, small companies are defined under 2 subsection 85 or etc. Can we get Excel format of new Schedule 3? Thank you. Okay, that has already been mailed across. Otherwise, at the end of my session, I will give them the ID, the web ID of our firm's website address. There you can take it in Excel editable format. Is there any specific Schedule 3 format for chit fund company? Chit fund companies, they'll have to take the NBFC format only. That is Division 3. Division 3 of Schedule 3. What are trade payables and the trade receivable for chit fund companies? Chit fund companies, trade receivables, the chit installments which are due will be trade receivables, chit installments. And if priced chits and all that, if they are payable, that will be trade payables. Priced chits and lots which have taken are not paid, they will be trade payables. Trade receivables will be if all your chitals, as they are called in the southern languages, or the the subscribers to the chits are fully paid, then you may not have trade receivables. But it's quite possible that there will be trade receivables because some of the chits may get default. If the chit is already priced lot and then granted, it will be a loan and only the net amount will be outstanding as a liability. In case of private limited company, whether turnover less than 50 crores, whether rounding off is required, can we give a whole amount without paisa? No, sir, it is not turnover less than 50 crores. It is 100 crores turnover. Now, rounding off is mandatory. If the turnover is less than 100 crores, then you have to round it up to the nearest hundreds, thousands, millions, lakhs or crores, lakhs, millions of crores. I repeat, hundreds, thousands, lakhs, millions of crores. Million is 10 lakhs. What should be the reporting requirement against chit fund company for chit installment and chit money payable in the matter of the aging schedule? I think I mentioned to the earlier question. Yeah, if they are more than the dues which have to be taken, chit receivables, which are the chit installments which are pending on the unpriced and unpriced and indisbursed, non-disbursed chits who are holding chit as investment. Like for example, 20 installments, somebody has paid 10 installments, 12, 13, 14 are pending. All the three would be a chit trade receivable. Then based on the age, you have to give more than 6 months, or less than 6 months, 6 months, 1 year, and so on. That's the way we do it. Any more questions, Selva?
It keeps on coming, sir. Do you want to take up now itself or else?
A few more we can take up, and then we'll move to CARO. But these questions are the other questions which are not answered now. You collect them and keep it ready. Even after CARO, we can discuss. Any exemption on reporting disclosure to small companies and OPC? Not under Schedule 3, sir. CARO both are exempted. Small companies and OPCs are exempted from CARO 2020. They have no requirement. Shareholders a struck off company, do we need to disclose? Yes. Yes, because in that slide, if you remember, shareholding by struck off companies has to be disclosed. Can we write off after finding that party we had transaction is now a struck off company? That's a call which you have to take. Struck off company, if it is not fully receivable, then a write off is highly advised. Whether we have to prepare separate accounts without rounding off for income tax purpose, if so, whether it has to be signed by all directors, and whether we have to prepare separate accounts without rounding off for income tax purposes. Oh my God. But income tax also rounding off, I don't know, to an extent it should be acceptable. Otherwise, you may have to, put the student on whether it has to be signed by all directors and auditor. Difficult question. Can some tax expert help me? To my knowledge, no. If they ask for, the department should also make sense out of why should they look at paise and hundreds, sir? Whether trade payable receivables can be obtained through management representation letter. Yeah, this is a very common question, sir. Management representation letter is not a substitute for audit evidence. The auditor has to do all the substantive procedures: opening balance checking, vouching, verification, physical verification, confirmations, discussions with the management, representation, oral representations, all kinds of proofs, overseeing physical verification of inventory, visual evidence on a building under construction. With all that, the auditor has to do. So please, for God's sake, don't think that you get a management representation letter and a trial balance, prepare financial statements and be done with it. No, it is only additional comfort for the auditor, saying that the management should not say at some point of time that we were not, this was not discussed. If you remember, in the bank audit, we are always advised to discuss the draft auditor's report, the draft LFIR with the bank manager. He may have something to explain. We cannot do it under cover. Same is the spirit with the thing. MRL management is responsible for so many things. One is that they are made to commit that these are our responsibilities, and we are saying that okay, all the liabilities have been provided for, trade payables have been disclosed, etc., etc. But for that, if there are trade payables, they have given a classification. We have to check that. SA 580 is written representations, only additional comfort for additional evidence for the auditor, saying that these points were discussed with the management, and these are the management assertions on yes, no, not applicable, etc. Can we get illustrative financials after incorporating revised schedule 3? Yeah, I will share towards the end of it. I had sent a mail. I don't know, some of you would not have received, and I will share my mail ID also, so you can get back to me. I can personally mail it across. I'll ask my team to do it, or end of this, I will let you know. Is it mandatory to round off to 100 even for small company? Yes. Do we get a list of MSME companies since companies will not declare? So that's a big issue. So everyone is facing that. MSME companies on the MSME ministry website, I don't think there's an exhaustive list. Even then, if you get a list of lakhs of MSMEs who are registered, even CA firms are today now allowed to be registered as MSMEs. We can, bid on the GEM portal and things like that. It will be very difficult. So one is that again, there's a representation letter is the second way of doing it, and then other than that, no. How practical to ascertain the list of MSME companies, debtors and creditors? Debtors, it's not required, sir. Creditors, if there is no utility available presently for the purpose. Yes, I agree with you. This remains a practical difficulty. And even earlier in the notes on accounts, we used to say that the company is in the process of identifying MSMEs, and there are no claims pending against the company from MSMEs for delayed payment, etc., under the MSME Act 2006, if I remember correctly. Regarding clause in CARO on verification of stock statements submitted to banks, how to practically go with this? Such companies submit percentage of GP basis only at the end. This percentage of GP basis is a ballpark method, and this is not acceptable. I did mention that while we were touching upon that particular point of quarterly statement of current assets in Schedule 3 itself. It is, you have to be gutsy enough to ask the management and check with it, and if there's a problem, we have to report. Management will have to face music. Percentage GP base is not maintainable, sir. With regard to promoter shareholding, a new person is appointed as director who is allotted fresh shares and is a regular decision maker of the company. Will he be classified as a promoter? According to me, yes, he will be promoted. He will not have any opening holding or opening balance of holding. Current year, there will be closing balance, and the percentage of change will be the 100% change in his case. Because opening nil, closing he may have few shares, so it's a 100% change. Is it mandatory to show items in broader head for purchase, sale, materials consumed, work in progress? Sir, please refer to the format, sale, all those things we have to, there are notes also to Schedule 3. All these things have to be given in detail. Show items in broader head for purchase, sale, yes, so purchases, yes, sales, material consumed. Material consumed, raw material consumed, we show normally as a note, or rather earlier we used to call them schedule. Opening stock of raw materials, purchase of raw materials, net of returns, less closing stock of raw materials. That is where the raw material consumed you will get. Work in progress also. Work in progress, yeah, we give only the total figure. In that we do not give the breakup. After rounding off, if is it mandated to show decimals? Sir, I don't think we'll have decimals after rounding off. Where a company has given corporate guarantee for non-corporate company, where to this company has given a corporate guarantee to a non-corporate company, maybe a partnership firm in which directors are interested. Guarantee is outstanding. Guarantee is outstanding. There will be a contingent liabilities because there is no accounting hit. There is no amount involved. That will be shown as a contingent liability. How to calculate percentage change in the base case of ratio, sir? Year over year. Last year, say for example, net profit last year was 18%. This year it is 20% net profit ratio. There's a 2% rise. Oh, I don't think there is any confusion there. Whether current maturity long-term borrowings included in current liabilities or computing current ratio. Yes, very much. For current ratio, for this purpose, for the Schedule 3 requirement. No, in the first place, current maturities of long-term borrowings are now reclassified under short-term borrowings. So the purpose of current ratio, the question is, though it's reclassified, just give me a minute. current ratio, current assets might divide by current liabilities. I'm of the view that though it is reclassified as short-term borrowings, for the purpose of current ratio, the current maturities of long-term debt should also be considered to arriving at the current ratio. That was the last question. I hope I have answered. Current maturity of long-term borrowings included in current liabilities. There is a change. Now the new classification is that they have been shifted from current liabilities to short-term borrowings. For the purpose of calculating current ratio, sensibly, it should that short-term borrowings, whatever is now reclassified into short-term borrowings, should also be taken into account for arriving at the current ratio. Otherwise, it will not reveal the correct position. Also, think of a case where there is a default of 8 to 9 months by March 2022. So 8 months plus 12 months, which are to follow, 20 months outstanding will be there, which is purely a current liability, which should be taken into account. That's what I feel. Regarding percentage of change in ratios, how to conclude whether the percentage current ratio, which is always measured a number of times and not in this number of times, also you can compare 1.8 times and 2 times. So the year over change is at 0.2%, 0.2% on the base year. If it is 1.8, that will be 0.2 divided by 1.8. The percentage change will be 11.11%, 11.11%. I think, Selva, we will stop now and move to CARO. And other questions also, I can keep collated.
Yes, sir. I'll compile it. Whatever that comes up hereafter, we'll take it up.
Yeah. Good work, Selva. Good work, Selva. It is useful, good learning for me, and I think I could give some answers to the doubts the members had. Really help the members. Good work, Selva. Keep it up. My screen is visible.
Visible, sir. Visible. Continue. Yes, sir. Visible, sir. Please continue.
Yeah. With that detailed discussion on Schedule 3, taking about 1 hour and 20 minutes. We are now getting on to CARO 2020. Very, very important. The first-hand responsibility for CARO is on the auditor. The management has absolutely nothing to do except to provide a conducive environment for collecting these details, cooperating with the auditor, and giving all the information required. CARO 2020 was notified as early as 25th February 2020, and we all thought that that would be made applicable from 1920. The industry as well as our institute said we are not really ready to meet all these reporting responsibilities, so it is deferred by 1 year, 2021. Further deferred to 21-22, and finally, CARO is now applicable for financial year starting on or after 1/4/2021. The overview of the order, if you look at, is that there are 7 new clauses, including 2 reintroduced. Modified clause, 7 clauses have been modified. 7 clauses have been retained. Totally 21 clauses and totally 47 subclauses. The reporting requirement on managerial remuneration, whether they are in compliance with section 197, that particular clause has been dropped. So 21, 7 new, 7 modified, and 7 existing clauses. We are now going to discuss the new clauses and the modified clauses one by one. But before that, the summary of changes, if you look at the new clauses, are transactions not recorded in books of accounts. We did have a discussion on Schedule 3. Ability of company to meet its liabilities, that is something which is totally new. We will see that the auditor is now required to have some bit of foresight, evaluate the financial strength of the company and see whether the company would be able to meet its liabilities falling due within 1 year from the balance sheet date. CSR, we had that in Schedule 3 as well, but here the transfer of unspent amount, the auditor has to comment upon. Statutory audit resignation. If the statutory auditor resigned during the financial year 21-22 and you or me have been appointed as auditors, we should interact with the outgoing auditor, find out what were the concerns and highlight that. Consolidated financial statements, the statutory auditor of the holding company has to highlight the negative remarks in the CARO report of subsidiary companies. Internal audit system, it has been reintroduced. Cash loss also has been reintroduced from CARO 2003. Internal audit, of course, reintroduced with some amendment also, some revision also. Modified clauses are fixed assets, inventory, repayment of loans granted by company, default in repayment of dues, reporting of frauds, Nidhi company, registration with RBI. Retained clauses, acceptance of deposits, whether they are in compliance with Chapter 5. Maintenance of cost records, if so required under Section 148. Loans, investments, and securities guarantees 185 and 186. Application of funds raised. Related party transactions. Non-cash transactions, directors. Timely payment of statutory dues. So, summary of changes. And for the information of the participants, SIRC has a practice of uploading these presentations if shared by the speaker on the website. Am I right, Selva? Selva, you there?
Yes, sir. Yes, sir.
Yeah, we normally, if I share this, it will be uploaded on the SIRC website, right?
Yes, sir. We'll be uploading the recording along with the material and website and also in YouTube channel. Maybe since it is a hot topic, we can compile it and send it to all registered participants or mail also in 2 days time, 1 or 2 days time.
That you have to discuss with the secretary, chairman, secretary if required. But I was just telling informing the participants that we have this good practice of uploading this on the website at least. Sending to individual this thing, I don't know whether that's a call which the chairman, secretary, and council has to take. So just for information, we'll continue.
Yes, sir, please.
Naresh sir, you said something. Naresh sir was online. No.
Sir, yes, just he said he'll be joining back again. So he's
no issues. I thought he said something in bit. No issues. So let's move on. So applicability is from financial year starting from 1st April 2021. Every company, including a foreign company, as defined in the Companies Act. Government company, no exemption applicable. Branches, if the branch audit is done by somebody other than the central statutory auditor, competent auditor they are called. The branch audits also will be, the branch auditor will also be required to give his CARO report. Not applicable to banking company, insurance company, Section 8 company, one-person company, small company, private companies. In fact, we had a lot of questions on the Schedule 3 applicability. Schedule 3, it's applicable across the board for all companies, every company. Schedule 3 is applicable, whether you're a small company, one-person company, etc. Yes, you have to comply with. And some private companies subject to conditions we'll see. Now on the small company, let me take a minute of yours just to give 2 updates on the definition. So recently, the monetary ceilings or limits have been raised. A small company is defined as a private company. Public company cannot be a small company. A private limited company whose paid up capital reserves does not exceed 50 lakhs. Earlier it was, now it is 2 crores. And the joinder is and. Earlier it was or. I'll tell you the difference. And the turnover as per the latest audited accounts does not exceed 20 crores. So 2 crores of paid up capital and reserves and turnover of 20 crores. So to be a small company, cumulatively, you have to satisfy both the conditions. Neither your capital and reserves should exceed 2 crores, nor your turnover 20 crores. Only then you will be a small company. I hope I've made point clear. And private companies, total borrowings not exceeding 1 crore at any time during the year. Total revenue as per Schedule 3 not exceeding 10 crores. Paid up capital and reserves not more than 1 crore. Now here, if you see, the guidance note says that small company under the Act shall be exempt, even if it falls under any other eligible category. Okay, in the category. So there's a feeling that this clause is redundant, but I think it may be in terms of borrowings and because since here also it is cumulative, if you go and definition of a small company, you may not go out of the definition of a small company. So if this has to be classified and then this becomes a little redundant, I just leave it for a thought or probably an interaction at the end of the session. Paid up capital includes equity and preference shares forfeited, does not include unpaid calls and share application money. For the purpose of this definition, I am highlighting this. what is paid up capital and reserves. Paid up capital, equity, preference, and shares forfeited, but does not include unpaid calls and share application money. Reserves would include capital reserves, revenue reserves, revaluation reserves, as reduced by the debit balance in the P&L account. So P&L debit balance now we are showing as a bracketed minus item in the schedule of reserves and surplus, right? Earlier it was at the bottom of the balance sheet. Now it is there. So from the reserves and surplus schedule or note itself, you can find out what the end result is. And debit balance in the P&L account, or rather accumulated loss will have to be reduced. We now move on to clause by clause analysis. New clause 1, internal audit system. Whether the company has an internal audit system commensurate with the size and nature of its business. This is a reintroduction from CARO 2003. But look at the new requirement. Whether the reports of the internal auditors for the period under audit were considered by the statutory auditor. According to me, this should have been made applicable only to those companies for whom internal audit is mandatory under the Companies Act. If you look at 138, right, with the rules, it says that internal audit is mandatory for certain companies. Private companies, I think there is a limit, exact monetary limit, I'm not able to confirm. But it doesn't, if CARO is applicable, the statutory auditor has to report whether there's internal audit system. If it is not there, we'll have to say that there's no internal audit system. Then most of the time the management would say we have in our own in-house internal audit department, they are the one who are doing it. Then the auditor in the second clause has to ask them for reports. There will not be any reports. Just an I-words they say to what that they have saying that internal audit. Recently we concluded one CNDG audit, which is a state public sector undertaking, Kerala state public sector undertaking. It's not actually Kerala public sector. We can say that it is a huge connect between Kerala and Tamil Nadu. A company called Kochi Salem Pipeline Private Limited. Gas pipeline is being laid from Kochi to Salem. And there the internal audit was there. Internal audit had luckily issued very detailed reports for the first 3 quarters. And since we finalized the audit by the end of April, the 4th quarter internal audit was just in progress. So parallelly, the internal auditors were in one cabin, statutory auditors in another cabin. And since it was a very non-firm, I spoke to the partner and said, sir, 3 reports we have seen. Last quarter also, if you can share a draft, it would be nice. And then based on that, we concluded that there's an internal audit system and we have considered the internal audit report for the as statutory auditors. We could give informed reporting there. So this is very important. And on documentation, again, things are changing. Earlier on, we used to have copies of hard copies. So a company, we just glanced through the hard copies there on site at the company. And then only the soft copies of the internal audit reports were stored. So today, audit documentation, we are reducing the size of the thick box files and having more of digital documentation. Not fully digitized, but I would say that all these reports, earlier on, during our articles, we used to say cash vouching, bank vouching, ledger scrutiny notes. All these students now do a trial balance analysis. They have a Excel converted TB format, and then alongside that, they write the notes. And finally, when we call for the scrutiny, say that, sir, in the client folder, I'll just show you from my laptop. That's the way they're doing it. So such changes can really happen, reduce paper, and we can still be effective. Clause number 2, nothing much to explain. Whether the company has incurred cash losses in the financial year and in the immediately preceding financial year, if so, state the amount of cash losses. Reintroduced from 2003. Unrecorded income, we have seen, we had explained in the schedule 3, whether any transactions not recorded in the books of accounts are rendered, etc., under income tax assessments, whether such unrecorded income has been properly recorded in the books of accounts during the year. Resignation of statutory auditor, whether there has been resignation, if so, whether the auditor has taken into consideration the issues, objections, and concerns raised by the outgoing auditors. Now, year before last, 1920, I think we had a lot of resignations in India Incorporated. PricewaterhouseCoopers, if I remember correctly, resigned from Reliance Infocom, which is a Anil Ambani group company. And the reason cited was what we learned in the first auditing class. I was teaching auditing for long 20 years at the Ernakulam branch. When I came into the regional council and had an office abroad, I had to stop. Still now teaching. Always say CA by profession and teacher by passion. So the first class in auditing, we say that the auditor should obtain sufficient appropriate evidence. Sufficient indicates the quantity, and appropriate indicates the quality or relevance of the audit. So this is a reason cited by PricewaterhouseCoopers in Reliance Infocom. I think the firm and the company is right. I just recalling from my memory. So if there is a reason, then this auditor should also be equally concerned. If X as an auditor could not obtain sufficient appropriate evidence, what is the magic the Y would bring in and say that whether the accounts are actually auditable at all? Many of those resignations happened in 1920 because auditability was still a huge problem. Concealment of evidence, lack of information, lack of explanation, lack of cooperation, all those things. So the reporting point is that whether he has considered the issues and objections raised by the outgoing auditor. Now, this is a new reporting responsibility about, somebody in lighter vein said that auditing auditors today in the chartered accountancy syllabus, a new subject should be added. It's called Jyotisham, we say. I think Jyotisham is a Sanskrit term. All of you would understand, or astrology or whatever. The art of predicting the future. The Gurujis, the Swamijis, the divine people are able to, define future. I always believe that the uncertainties of future is what makes the life thrilling today. If you know what's going to happen in the next 3 years, what is the whole charm and fun in living? That's my personal philosophy. But here, coming back to this very, very demanding, onerous, challenging reporting responsibility, on the basis of financial ratios. Where do we get the ratios now? Handy in the financial statements. We ourselves prepare it. Aging and expected dates of realization of financial assets, that is, receivables, loans and advances, other current assets other than inventory, or monetary items. Payment of financial liabilities, other information accompanying financial statements. The auditor's knowledge and discussion with the board of directors, management plans, etc., etc. Whether the auditor is of the opinion that no material uncertainty exists as on the date of the auditor's report, that the company is capable of meeting its liabilities existing at the balance sheet date as and when they fall due within a period of 1 year. It is not indefinitely in the future. Whether those things which are falling due within 1 year, the company would be able to service, pay off, honor the commitments. So the auditors required to have foresight. If not, then their details will have to be given. Verify the realizability of, I've written, this is a bit from the guidance note, these are my points. Verify the realizability of receivables and other financial assets. Board's documentation of the liability position payable within 1 year. Specifically, all the material events and transactions post balance sheet date but before the report date, the paying capacity, etc., in the management MRL, and knowledge of the management board has been communicated to the auditor. And the medium of communication is additional points we'll have to bring in the management representation letter. Now let me talk about SS for 1 minute. Standards in auditing till 2013 Act came were just dictums of the institute on the membership, saying that, hey, CA, look here. If you do not comply with, if you're found not complying with standards in auditing, they were called SAP standard auditing practices. SAPs earlier, then they were converted to AAS, AAS, auditing and assurance standards. And now with the new preface issued in 2008, we have standards in auditing, standards on review engagements, standards on assurance engagements, and standards on related services. Engagement standards are broadly classified into 4. So that is the case, and therefore they said this was a case. But 2013 Act, when it was enacted, 143, section 143, which is a very important section under Chapter 10. Chapter 10 deals with audit and auditors, 139 to 148 sections. There, 143 subsection 9 very categorically says that every auditor, I repeat, every auditor, not every management, not every the board of directors, every auditor shall comply with auditing standards. So they are now gaining statutory teeth The MCA can take action against non-compliance with SS by auditors. The NFRA can take action. Therefore, one has to be extremely careful. And I'm saying this in the context of discussing the importance of a management representation letter, which is mandated under SA 580 written representation. Transfer of unspent amounts, CSR amounts to funds. So there's a distinction between 135.5 and 135.6. The first one deals with other than ongoing project. Ideally, it should have been the other way around. Okay. Oh, I'll tell you what an ongoing project is. Ongoing project is a CSR project, which is essentially a multi-year project. Multi-year project is that it will run for more than 1 year, but not exceeding 3 years. You cannot have a CSR project running into 5 years, by definition, by the CSR provisions. So this is happening, and therefore we say that this is going to exceed more than 1 year. It's going to take 2 years, 18 months, 27 months, and so on. So they're called ongoing projects. So in the case of ongoing projects, if the company is not able to spend what is unspent at the end of the financial year, let us say the commitment of ongoing projects, commitment of CSR under ongoing project is 5 crores. And by 31st March 21-22 financial year, by 31st March 2022, we have incurred only 2 crores. 5 crores is the commitment, requirement or mandatory amount to be spent, which is classified on ongoing projects. Only 2 crore, 3 crores has been spent. The balance 2 crores, you have to park it in a bank account. That is the second clause, second bullet point. You have to park it in a special account in compliance with section 135(6) of the Act. And it can be spent only for CSR purposes. This is comparable to our capital gains account under the income tax. Capital gains account, if that capital gain is not being able to be invested in a residential property, etc., etc., the unspent amount will have to be parked, and which can be withdrawn against a CA certificate only for the set purposes, failing which the unspent amount would be brought to tax. This is one thing. And CSR is not tax deductible, everyone knows that. Now come to the first bullet point. Other than ongoing projects. Other than ongoing projects are which are to be spent essentially in 21-22. There is no overlap into the next year. Spent during the financial year. If that is not spent, within 6 months from the close of the year, it has to be transferred to any of the fund, which is the Prime Minister's Relief Fund, Chief Minister's Drought Relief Fund, Flood Relief Fund. They have to be transferred and never come back to the company. So which means that you have really failed to spend, then it goes to the government. And the government would spend it for social welfare, presumably. That's the thinking. So the auditor has to evaluate. Question number 1 is CSR applicable by virtue of the profits, turnover, and one more criteria, net worth. Turnover, net worth, and profits. If applicable, yes, what is the amount to be spent? What is the board? The CSR committee is mandatory. Get the minutes of the CSR committee. And based on that, you have to arrive at this and make sure that these provisions are complied with. Failing which, we have to report in the negative. The new clause 7, which is the last new clauses, we found that there are 7 new clauses. Whether there have been any qualifications or adverse remarks by the respective auditors in the CARO reports of companies included in the consolidated financial statements, indicate the details of companies, paragraph numbers of the CARO report containing qualifications and adverse remarks. This will come in as an additional item in the CARO report of the holding company, or a consolidated in the CFS, in the consolidated financial statements, they have to be mentioned by the auditor of the holding company who prepare, or rather who audits the CFS, consolidated financial statement. So these are the important 7 new clauses under the CARO 2020. Now we will move to the modified clauses. Fixed assets, the existing clauses, full records, quantity, details of property, plant and equipment, rather fixed assets it used to be. Now the new reporting requirement is whether company is maintaining proper records showing full particulars of intangible assets. If you take last few years, the amount of intangible assets have substantially increased. In earlier days, I'm in the 30th year of my practice. Revati ma'am said I've completed 39 years. It is not 39, 29 years. 30th year of my practice. And, you know, the the composition of assets have changed, particularly in the case of service companies, IT companies. They are not asset heavy in terms of property, plant and equipment. And slowly the brick and mortar models are slowly, the charm is reducing. Of course, there's a coming back also. That's saying that, okay, work from home cannot be temporary, it cannot be permanent. Like Satya Nadella famously said, it cannot be a permanent feature. Let us come back to office, meet each other. Let us have the office friendships, office gossips, and let us not burn the social capital we built over the so many years. That's what Satya Nadella said. Narayana Murthy also mentioned that we have to come back to office and work, and the effectiveness is there. And therefore, here there are large number of intangible assets in the balance sheet, capitalized based on the sound accounting principles like AS 26, amortized over a period of time based on the assumptions given in AS 26. So if it is now, the composition is not goodwill, it's not patents. Mostly you find that computer software. Asset is having value, but no physical substance by definition. All those for them also you should have the records of asset registers are making sure that there's proper control over those assets. So this is a new reporting requirement. And the other one, again, modified clauses. First clause is okay, we used to have that. Now here is a clause which we already discussed in Schedule 3, whether title deeds of all immobile properties, other than properties where the company is a lessee, are being disclosed in financial statements. If not, provide the details thereof in the format below. If there are immobile properties in the balance sheet which is not in the name of the company, the format given below. Format I had mentioned, the same format there in CARO also. What is it and whose name it is held, whether that party is a related party, and what is the reason for not holding in the name of the company, and the period for which such a property has been held. Those are the details which are to be given in the modified clause. Registered valuer clause also is new, whether the company has revalued its property, plant and equipment. If so, whether the revaluation is by a registered valuer, and if change is 10% or more of the aggregate net carrying value, then the details are to be given. Second bullet point is again a repeat from Schedule 3. That is the Benami transactions. Any proceedings have been initiated or pending against the company, then the auditor has to report. If so, whether the company has appropriately disclosed the details in the financial statements. Inventory, I put in a different color what is new. Whether physical verification inventory has been conducted at reasonable intervals by the management. That used to be there. But look at this. In the opinion of the auditor, whether the coverage and procedure of such verification, by the management is appropriate, whether any discrepancies of 10% or more in the aggregate of each class of inventory were noticed, and whether they have been properly dealt with in the books of accounts. So what is really new is coverage and procedure. Now let us discuss whether physical verification is done by the management at all, and what is the auditor's responsibility or auditor's involvement in the physical verification. At least year-end verification. Of physical inventory. A company with inventory of, let's say, 10 crores of rupees. Many of us are happy with an Excel sheet given by the accountant saying that this is a year-end stock. Whether they physically exist, whether the values are proper, whether they are in saleable condition, whether perishable items have been, whether perished or items of value deterioration has happened, has been valued or not valued or valued at lesser rates, etc., etc. That kind of a check is not happening. I would invite your attention to SA 501. Standard Auditing 501 is an offshoot of SA 500 audit evidence. SA 501 is special considerations for additional items. Specific considerations for selected items. Of that, item number 1 is inventory verification. The standard, the mandatory auditing standard, mandatory by the institute, mandatory under the Companies Act under 143(9), requires that the auditor should be physically present, either in person or through representatives, competent representatives who should go and oversee the physical verification. You don't have to carry the sacks on your heads, do the physical counting in a dusty, noisy factory. You have to be there, make sure that there's a process, You all see that, and this count they have taken, the payment they have taken, the dips they have taken are reliable, and that is a physical stock. And when you compare with the book stock, if the book stocks are updated, and that much has to be done the minimum. So here, this is bringing a thrust again for the sake of a banker or anyone, for the company also. One way it's good that if their managements are responsive to the auditor's suggestions. Incidentally, we have a new vertical, which we call it corporate doctor. That's not for our audit clients. Completely non-audit clients, and sometimes a lot of new people come to us knowing that this vertical is very effective. We get into an organization and do a complete diagnosis, processes, people, MIS, quality of people, quantity of people, processes, technology, to what extent they are leveraged. All those things we do and find that there are a lot of lapses. And huge value savings are possible, huge value additions possible, highly lucrative assignments. So that is incidental. So here as an auditor, year-end verification has to be off. And now we see that drones are sometimes doing it in the fields and all that. I will just share with you an example. The company is a non-company. It is Indigo Paints, the Zebra and MS Dhoni. Indigo Paints had taken over a unit in Kochi in the industrial area called Kalmasheri. Company called Hybel Coatings, which is owned by a friend of mine, very senior person. He's an IIT-IIM. He's my member in my Rotary Club. So I got a call during the COVID time, got a call from him. And after this became Indigo, they audited by EY. Indigo has done an IPO and the prices are ruling high, I understand. Very focused company from what we know. I'm not vouching for that. So EY was not able to travel from Pune to Cochin to do a physical verification. It's a listed company I'm sharing, but it's a very good process. So they asked the promoter, or rather he was continuing as the CEO of this particular unit. That company had disappeared because that was merged into Indigo. And they asked him to find a medium-sized firm who can do a physical verification here on behalf of them. And there's a lot of detailed appointment letters, references. And finally, we took it up. And the first instruction was to send a photograph. The team has to take a photograph in front of the factory saying that we have arrived. The entire physical verification process was videographed and then live. A person was deputed sitting and watching all this. 10 samples of raw materials, 10 samples of finished goods. And then towards the end of the afternoon, they said, randomly you pick another 5 items of RM and FG and check over the reports. So this extent where if you cannot do it, you can probably outsource it also. Geographical difficulties, manpower constraints if it is there, but to a reliable process which is under supervision. Should not be bothered for the sake of it. And I'm sure that with a lot of bad loans likely to emerge, the lens on the profession, the surveillance on the profession is going to be substantially stronger. And therefore, one has to be extremely careful. We cannot take inventory for granted. The physical existence, the physical or the condition, existence and condition of the stock, fair valuation in compliance with AS2, cost or net realizable value, whichever is lower, is a cardinal principle in inventory valuation. Due provision for non-moving and slow-moving stock, all those things have to be done. That's from a valuation perspective, true and fair perspective. But here is talking about the physical procedure which has been adopted and the coverage which has been done. This is the other point we discussed, whether at any point of time during the year, the company has been sanctioned working capital limits in excess of 5 crores. In Schedule 3, we found that irrespective of the amount of working capital loan, etc., it was applicable. Here it says that whether the quarterly returns of current assets, we had a few questions also in the chat box in Schedule 3 part, whether these quarterly returns filed by the company with banks and financial institutions, agree with the books of accounts of the company, if not give details. Now here I wanted to take a constructive interpretation, saying that I don't know whether it's constructive or destructive. I took an interpretation that a possible interpretation I was discussing in all the forums where we presented this. We have 2 more to go immediately. Day after tomorrow in Trichur and Saturday in Palka. So 2 Kerala branches doing this. So I thought we'll interpret in a way that this clause will be applicable only if a working capital limit of more than 5 crores is sanctioned during the year. If there's an operating facility, let us not bother. But some of the seniors felt, I think that wisdom is safer and better, that these limits are renewed every year. So renewal of a limit should also be in one way seen as a fresh sanction, and therefore this clause would apply even in the case of an ongoing facility of more than 5 crores which was there or sanctioned during the year. I was just sharing that interpretation. One would like to avoid reporting under the clause, taking the suggestion which I had, but this is more of a, I think, sensible and wisdom-based, experience-based view. Whether during the year the company has made investments in, provided guarantee, etc., to companies, firms, limited liability partnerships. If yes, detailed reporting requirements, modified clauses. Aggregate of amounts lent or invested in joint ventures, subsidiaries, and associates. Aggregate amount of such advances, loans, etc., in parties other than subsidiaries, joint ventures, etc. The full details of that has to be given. That is to be given, and whether investments made, guarantees provided, etc., are not prejudicial to the interest of the company. Not given, the auditor has to comment upon all these things. And look at the last bullet point. If the amount is overdue, state the amount overdue for more than 90 days. So the 90 days parameter is from the IRAC norms of the Reserve Bank of India, income recognition asset classification, which we are so familiar in the bank audit scenario. That kind of a 90 days criteria has also been brought in here, the auditor to see whether if the repayment is overdue for more than 90 days, whether the management has taken reasonable steps for the recovery of principal and interest. Whether the loans and advances have been granted with has been renewed and extended for fresh loans granted to settle all dues. That also has to be reported. This we call it evergreening in the case of bank audit. In the context of bank audit, we call them evergreening. A new loan is sanctioned to repay the old one and say that this loan is fresh and new, which is actually an eyewash, and to say that all loans are not outstanding. So such cases should be reported. And the company has granted any loans in the nature of loans repayable on demand or without specifying the terms of period of repayment. Most of these terms and loans and advances, at least in private limited companies, we would see that it's just given and there is no repayment specification. Such cases also the auditor should see whether they're prejudicial to the interest of the company and if the repayments are forthcoming. I've just pulled out something from in the guidance note. Their past due reporting, more than 90 days aspect has to be checked, and reasonable steps here wouldn't mean that legal action has to be taken. The management has taken issued letters, sent notices to the defaulting parties, and that's fair enough. That can be taken as reasonable steps. It is not that a legal action has to be initiated. That is what the guidance note says. Management is given happily that is outstanding for more than 90 days, more than 1 year, no response, the management is not bothered, no confirmations obtained, then that has to be, red flagged and reported. That is the whole point I'm trying to say here. Default in repayment of dues. Here we have seen, as in the case of Schedule 3, whether the company is declared a willful defaulter by any bank or financial institution. Whether loans are applied for purposes for which they were obtained. If not, whether the loan has been diverted and the purpose for which it has been used should be given by the auditor. The last point is a very valid point, whether the funds raised on short-term basis have been utilized for long-term purposes. If yes, the nature of amount has to be indicated. This is reintroduced, very sensibly so. Prudent financial management requires proper fund management. And here, utilizing short-term funds for long-term applications is really dangerous. It puts you in a vicious circle, inescapable vicious circle, I would say. In the first CARO 2003, if you remember, there's also said, or vice versa. Vice versa was redundant and they dropped it because a portion of the long-term funds are always part always applied for short-term applications. That's the way it should be. We have that margin on working capital. Those who are in project finance would know there's margin on working capital. But no single pie of short-term funds can be used for long-term applications. Typically, from out of a newly sanctioned working capital facility, you go buy 2 vehicles, one for the MD and one for the executive director. It's not advisable because your working capital limit is an optimum facility which has to be used for working capital only, funding your inventories and receivables or net working capital. Instead of that, you've gone for buying 2 high value, a Merck and a BM. It's dangerous. That has to be reported. Default, whether the company has taken funds from any entity and obligations, subsidiaries, etc. Whether such complete details of transactions have to be given, and whether the company has raised loans during their on the pledge of securities, that also can happen. The company has investments in associates, subsidiaries, etc. Their value depletion would have happened, would not have happened also. There, if they have defaulted in the repayment of such loans raised based on the pledge of shares in securities, subsidiaries, etc., it's a dangerous point that has to be reported. Fraud reporting also a new clause they have brought in. Whether any report under 143.12 has been filed with the auditors under in form ADT 4 under Rule 13 of the company's audit and auditors rules to the central government. Here, a fraud detected normally has to be reported by the auditor to the board of directors. But if the amount involved, the quantum of the fraud is more than 1 crore, the law mandates, the rules mandate that the auditor should blow the whistle louder, or rather report it to the central government in Form 84. If such an instance is there, whether that has actually been done is the point which has to be reported. And here again, whether the auditor has considered whistleblower complaints, if any, received during the year by the company. There also in the guidance note, they're making a reference to the RBI circular. A whistleblower complaint is something which of a grave intensity, very important aspect which can question the existence of the company, or a major fraud or a major non-compliance with violation of the statute, etc. A whistleblower, the auditor also today has to, we are trained and we take insurance in Kingston Cotton Mills case, which was delivered more than 100 years ago, where the learned judge is supposed to have said, the auditor is only a watchdog, not a bloodhound. But times are changing. The audit responsibilities, the public expectation, all that is changing. The regulators' expectation is evident from what we see in CARO 2020, that the expectations are climbing, going up. Therefore, one has to be extremely judicious and careful in discharging this. So if there are whistleblower complaints, yes, the auditor has to highlight that there have been complaints against the company. This is again from the guidance sort I've taken. Moving forward, a Nidhi company. Now, Nidhi companies, many of them have not been able to renew their licenses. NDH4 or whatever that could not be filed. Here the point is where auditor is concerned is, if it's a Nidhi company, whether net on funds to deposits 1.2 has been met to meet the liabilities. You can have 20 times of your net on funds as deposits accepted. A Nidhi company by definition should have more than 200 members. It can accept amounts from the members and give to members. But many of them have been, using that for NBFC activities or outsiders. That's why the ministry is now very, very skeptical and keeping a very close eye on the performance of Nidhi companies. Again, they also have to require mandatorily 10% unencumbered term deposits of the complete of deposits to meet out the liability, the outstanding deposit liability. 10% of that the company has to maintain in unencumbered term deposits, fixed deposit, whether that has been done. And the new clause is whether there has been any default in payment of interest on deposits or repayment thereof for any period. You saw the details thereof. This is a new clause. The third clause is new. Whether the Nidhi company is regular in repaying the interest as well as the principal wasn't in default due to the depositors. Registration with RBI. The question number 1, which used to be there, is that whether the company has obtained or whether it's required to be registered under 45IA of the RBI Act. The new point is whether the company has conducted any NBFC activities without obtaining a valid COR, Certificate of Registration, from the Reserve Bank of India. That is more fatal, more dangerous. So therefore, that's the new reporting clause the auditor has to. So the auditor has to find out whether this company has carried out non-banking financial business. They have suggested some parameters. We'll come to that. Wait a minute. Yeah. Look at the last bullet point as since we have this thing. Examine financial statements to ascertain whether the company's financial assets constitute more than 50% of the total assets. Financial assets. And the income from financial assets constitute more than 50% of the gross income. In such situation, it is deemed that the company is an NBFC, or rather, the company has done NBFC business, which would necessitate registration with the RBI as a non-banking finance company and obtaining a valid certificate of registration. If that is not happening, then yes, the auditor has to report negatively under this report, under this particular point. I'm sorry. Again, in the case of a core investment company, whether the company is a core investment company by definition, it is an investment company with more than 100 crores of capital and which can have a whole lot of subsidiaries horizontally. Vertically, again, for a CIC, the layer of investments would apply. And whether the CIC compliances are the provisions of CIC core investment company regulations are being complied with. And as more than CIC as part of the group indicate the number of CICs which form part of the group. This again is slightly a bit of going outside the scope of this thing. The auditor of this company has to find out whether there are more than one CIC in the whole group of companies. This is actually quite demanding and difficult, but as it requires that kind of a reporting. So again, you have to see the annual reports in the listed space, as well as the discussions, the register of contracts with the related parties under 189, the disclosure of related parties, all those things you have to see. And for the group, if CIC is there, you just got to report the number of CICs in each group, which I don't know, really doesn't serve any purpose that from a financial management point of view of this particular auditee company. That brings us to the end of the new clauses and the modified clauses. And we will round up in another 5 minutes, just highlighting these new requirements under Rule 11 of the Audit and Auditors Rules. We had seen that intermediary, the UAE, Sri Lanka example. Here, the auditor has to say whether the management is represented. Again, the word used is management is represented, that no funds which are not disclosed, other than what is disclosed in the financial statements, have been, in the example, received, advanced, or invested, etc., with the understanding that this should be on behalf of some other party, funding party should be given to another party. And there is nothing that caused him to believe that the representations are misstated. They are labeled. The company is saying that there has been no such transactions. And whatever is there, not to this extent, which are in compliance with the provisions of FEMA, etc., have been duly disclosed in the financial statement. And also one more clause they have added in these rules, whether the dividend declared or paid during the year is in accordance with section 123 of the Act. Interim dividend as final, as well as final dividend, section 123 has to be complied with. Opening a separate dividend account, transferring all that to that particular account, then undisbursed amount, all these things, all the compliances have to be there. One thing I would like you to take note is that for the last many years, at least for the last from 2016 onwards, there is no need, or rather we should not account for proposed dividend. I'll put it like this. March 22 account we are finalizing now. The audit is finalizing. The board says, auditor sir, we are recommending, the board is recommending a dividend of 20%. Dividend of 20% for the financial year 21-22. So earlier on we used to provide, when they say that proposed dividend as under the below the line, or rather as pre-annual appropriation, proposed dividend, and of course CDT was also there, corporate dividend tax. That is gone now. Dividend is now taxed back in the hands of the recipient shareholders. But this per se, according to AS 4, Accounting Standard 4, contingencies and events, contingencies are taken out, events occurring after the balance sheet date is not an adjusting event requiring an accounting hit as on 31/3/2020. The final dividend, when it is declared and paid in the AGM this year, we'll account for it. But a mention is required in the notes on accounts. Board's report, it will be there. Board will be very happy and proud to say that we are declaring a dividend. In the notes on accounts also, it's required. That's a AS4 requirement. I thought I'll just remind you. So with that, I think we have come to the end of the presentation. I will take a few questions, no doubt on that. Try to answer them. And useful references, as I mentioned, Institute of Chartered Accountants of India, guidance on amendments to Schedule 3. 3 volumes are there. That is Division 1, non-Ind AS, Division 2, Ind AS, Division 3, NBFCs. Guidance on CARO 2020. The booklet I bought, and then useful references are there. So let us try to comply with the requirements. And as I mentioned in my mail, every one of us today, as a individually and as a profession, we should become champions of good governance, champions of change, positive change, and demanding requirements. One has to familiarize, train your team also. We had three training sessions in our office for our students. We have a good number of students here, and they are the people, they are the field workers, so they have to be taught from PowerPoint presentations by the students under the supervision of a partner. I too did one presentation and told them the approach to audit this year. Again, on top of this, we have to have all the accounting standard compliances. Never to dilute the importance and relevance of standards in auditing. They are the instructions, guidance on how audits are to be discharged. The attestation functions has to be discharged. So therefore, let us comply with all that. Let me conclude with this, thanking all the participants for staying relevant. The questions in Schedule 3 suggested that you were actively involved in presentation, not just switching on the screen and remaining passive. I'm really enriched, honored to be doing this presentation for SIRC, and I would only be happy to answer your questions. So a big thank you. Before that, let me also, Selva, just give me a minute.
Yes, sir.
This is my mail ID. Please keep in touch. Anything that you need to discuss on matters of professional interest, cajomonkgeorge@gmail.com, cajomonkgeorge@gmail.com, and www.jvr-cas.com is the website of our firm. You may get some useful information there also. I hope the slide is readable. My mail ID is cajomonkgeorge, JOMONKgeorge@gmail.com, and the web ID of the firm is JVR. My number is 9847031343. It's not useful reference, it's contact. I will change the caption person. The slide is visible, Selva. The contact
visible,
details.
Sir. Yes, visible, sir.
cajomonkgeorge@gmail.com, 9847031343, jvr-cs.com. So big thank you to all of you, and also to Revati ma'am for the nice introduction. You have been a wonderful colleague in the council. Narendra sir, Gilli sir for his guidance and all the active participation, doing exceptionally well. The Hyderabad duo, Chinna and Chinnamasan and Naresh Chandra Gilli, good team, and happy to associate with any programs of SIRC. Thank you so much once again. And Selva, if there are questions,
yes, sir.
if time and mood permits.
Yes, sir.
Yeah, you can.
We'll take it up. We'll take up. So I have compiled it already, and we'll take up the question.
Please.
Visible, sir? One. Naresh sir joined over mobile actually. He's,
Sir is there. Great.
yes, sir.
Yeah, I'm there on mobile, sir.
Good, sir.
So
Good.
is my screen visible, sir?
Yeah, visible.
I will just, yeah, it's visible. Just give me a minute. Oh.
Assumption, this is the question we left out. Last question is this from this view.
Yeah. Does the exemption list under old CARO continue under CARO 2022? CARO 2020, sir, not CARO 22. In the slide which will be shared, that exemption list is banking companies, insurance companies, one-person companies, private, small companies, Section 8 companies, and private companies, and under those three criteria, which is there in the slide. That 1 crore of borrowing, 10 crore of capital, and one more is there. Turnover criteria. I'll just I'll show you the slide quickly. The slide visible, Selva?
So I'll just give you the rights. I given you the rights. You can share it. Click share. Visible.
Can you see it? Yeah.
Yes, visible.
Private company borrowing should not exceed 1 crore. Revenue should not exceed 10 crore. Reserves and surplus should not exceed 1 crore. These are the exemptions, and the slide before that also hope you have seen. Banking company, insurance company, Section 8 company, one-person company, small company. More or less the same as in the case of a CARO 2016. Yeah, you can go back to the questions, sir.
Yes, is it visible, sir?
Not yet.
Click on the application, it should be visible.
You can close my presentation.
No, you need to close your. Is it visible now, sir?
One sec. One sec. Yeah, can make it big. This full screen. Can you make it?
Yes, sir. You can make it.
I think so. Yes. Whether small company definition includes paid up capital and reserves, both or only paid up capital. 2 subsection 85. Let me have a quick look, sir. I'll come back to you on that question. 1 minute. Whether cash flows to be considered as per cash flow statement is operational cash flows. No, sir. Straight away, P&L, that is your loss without depreciation. I lost the screen again. You don't have to go to the operating profit and the operating cash flow from operating activities. So the P&L, just to the, if you have a loss, disregard the depreciation, and if you have this thing is a cash loss. Private company whose PUC and reserves is 1 crore and turnover at 10 crore as per latest balance sheet and is 100% subsidiary of a foreign company, whether CARO is applicable to this company. That of a 100% is a 100% subsidiary of a foreign company. Private company whose paid up capital reserves is more than 1 crore, turnover is 10 crore as per latest balance sheet. 100% subsidiary of a foreign company. No, sir, it will not be applicable. If it's only Indian public company, if it's a subsidiary of an Indian public company, it will be applicable. Company sector, volume 1. Check applicability of CARO definition required as are told, but as per section only paid up capital. Availability CARO definition. I'll just check it. 285. Did I say paid up capital and reserves? Let me double check. This is on the definition of small company, right? It's in subsection 2, subsection 85. Just give me a minute. Paid up share capital is there. I stand corrected. It's only not reserves. Reserves are not to be considered for the private small company definition. I repeat, the small company definition is where the paid up capital does not exceed 2 crores and the turnover does not exceed 20 crores. Sorry for the misleading. What about comment on unspent amount on earlier years? Please clarify. That is not required to be reported, sir, because that mandatory applications come from 2021 only. Is there any change in main audit report format in these lines for the FY 21-22? Not in the main report. If you look at the last two clauses I mentioned as per the rule, it is not in CARO. So those 2 points on that dividend as well as the company as acting as an intermediary, anti-money laundering point, that will be in the under other legal and regulatory requirements. There, those 2 new points will have to be added. Other than that, there's no change in the main body of the report. Whether ICAI will make suggestions to CBIC to notify particulars of the ABSC registration to be disclosed in the sales invoice of the supplier. It is not the ICAI to do that. ICAI, of course, I wanted to go to the council. I'm not there. But I think that is something which the ministry has to be alerted and the ministry has to so modo do it. We can be an agent also. We can tell them that to get the real benefit for MSMEs. A lot of trust on MSMEs now. So I think it's a good suggestion. If in case cost audit is applicable, cost audit report is sufficient in relation to clause related to inventory. No, sir. Cost audit report is quite secondary. Inventory, the reporting points are very clear, very straightforward. Whether the management has conducted physical verification of inventories at periodic intervals, whether the coverage and procedure is reasonable. That the statutory auditor need not should not fall upon the cost audit report. Whether paid up capital includes securities premium also. No. A company is a small company but not a specified company. CARO 2020 is still applicable. That is debatable. So if it's a small company, then the guidance note says that without reference to other criteria, which is the borrowing criteria, CARO will not be applicable. So you can take guidance or rather shelter in the guidance note which says that small company, if you're a small company, you are exempt. Don't look at the other criteria of borrowing. If the interest is not repaid but instead added back to the principal and carry forward, have to report the case since it's a related party loans. If that is as per the provisions of, or rather in terms with the provisions, in terms of the sanction terms, negative sanction terms, I don't think there's a problem. But interest also, the payment has to happen periodically. You cannot just add it on to provide and add it on to the loan account and say that there's a complaint. Sir, modified clause 4, does it include diversions done in previous year only during the year under review? I think you have to take a comprehensive view. It just cannot confine to the year. If there is evidence that there is a diversion in earlier years, that should also be the same. Is CARO applicable here? Net owned funds 90 lakhs. Net owned funds, CARO applicability is not in terms of net owned funds. Turnover 9 crores, bank loan 2.5 crores. Bank loan 2.5 crores. The borrowing has exceeded. If it's a small, it's not a small company, right? The loan has exceeded 1 crore, so it will be applicable. Loan criteria is 1 crore, right? Just give me a minute. Just a minute, sir. I'm just getting it. Yeah. Private company, yes. Yeah. Borrowing, if it's not a small company, the borrowing exceeds 1 crore. Therefore, bank loan 2.5 crores, CARO will apply. As far as promoters are concerned, can we take data from the previous year annual return filed with ROC and make necessary reporting for the current year? That will be useful reference. There could be other sources also, like if there's an offer document, discuss with the management and also apply the principles like whether they are in charge of, they can really control the affairs of the company, etc. Delayed payment of interest on loans would be considered as a default in payment of interest. Whether delayed payment of interest on loans. Yes, naturally. Principal as well as interest has to be serviced on a timely basis. Sir, modified clause 7 applies to chits also. Modified clause 7. Let me just take a look. Oh, about the chit company. You're asking about chit, include chit companies also. Chits, I don't think there's an RBI registration required. My knowledge, it is not required. So they are on a different footing, though they are broadly NBFC is not coming under the direct supervision of RBI. I'm not too sure. I have to check and get back to you. Please shoot a mail to my ID. I would probably reply on a one-to-one basis. Financial assets include fixed deposit with banks for the purpose of 50% ratio of income. Yes, quite very much. Can we have full set of illustrative financial statements for non-Indian companies, including the auditor's report and board's report? Other reports are for audit, including auditor's report and board's report and other reports that forms part of financial statements. I can write. I can share it with you. Please shoot a mail. I've shared my mail ID cajomonkajor@gmail.com. I had in fact mailed to across, but some of them had a problem opening it because opening in Google Groups or something. It has to be saved as a file, save as an Excel file or something. Some instruction was there. My team who did the mass mailing. But anyone who requires this formats, I'm only happy to share. Do not attach much of an IPR, intellectual property right, except that some homework has been done. So it should not be a problem. I can share.
Those were the questions and some questions.
That brings us to the end of the questions, right, Salva?
Yes, sir. Some questions that came up after we have compiled this one. So maybe we can send it to your mail. Time permits, we can respond it, sir. Or else do we take it up?
If it is possible to be disclosed, I mean, because those who have raised the questions may still be online. We have only 640 participants now. So if you have few questions, yeah, apart from amended CARO, whether internal financial controls or financial reporting, yeah, it has to be the IFC is a completely different story. It has to continue in applicable cases. On computation of drawing power, if there is a shortfall, will it amount to short-term funds utilized for long-term purposes? No, drawing power is a completely different story. Drawing power is from a banker's angle. Short-term funds, you know what short-term funds is? The moment you have current liabilities in excess of current assets, it is a rough indication that short-term funds have been utilized for long-term application. Don't go by the drawing power. Take the real position of working capital loans, current assets, and current liabilities, including working capital loans. And if current liabilities are in excess of current assets, it's an indication that short-term funds are used for long-term application. Can a relative of the statutory auditor of the company be the internal auditor? Different firms in different cities, though own brothers, company be the internal. Can the relative of the statutory auditor? No, sir. The prohibition under 144 would squarely apply. Because directly or indirectly, so relative would also be covered there. Same company, right? Different firms in different cities. No, that should not be. FD long term, including FD against bank guarantee, will be financial assets. FD long term, including FD against bank guarantee. Yes, will be a financial asset only. Any limit is there for internal audit requirement? Yes, sir. 138 read with rules. Just give me a minute. I have some reference here. I hope so. Internal audit 138 with the rules. Just forward. I will just try to answer that, just taking some reference. CARO not attracted as it's a small company, but some clause of CARO may be applicable. What do this? No, if you are a small company, sir, no questions asked, CARO is exempted. That's what the guidance note says. Whether a core investment company needs to be a limited company, if no, whether partnership firms can be reported as core investment company. Need not be a limited company, sir. Private limited company can also be a core investment company. The definition is more than 100 crores of investment. Just give me a minute. Core investment company are specialized non-banking companies that need to go NBA registration, which have an asset size of 100 crore or more. And their business is just acquisition of shares and securities. That's the definition. And so need not be a publicly limited company. But partnership firms do not come under core investment company. Partnership firm cannot be a core investment company because one is a capital, of course, that is possible, but they cannot hold shares, no. For CARO applicability, whether borrowings, including borrowings from related parties. No, sir, only external borrowings. Related party borrowings, so we used to call them unsecured loans. They are not to be considered. Borrowings from banks and financial institutions. Financial includes, for the purpose that we have answered, FDs are not included in fixed assets as per RBI. FD are not included in financial assets as per RBI. Sir, I have to double check. I'm not too sure. According to me, FD should be part of the financial assets. Because it can be an investment of the surplus funds for interest earning, and therefore that's what I feel. But I'm open for debate. I'm not concluding there.
Those are the questions.
One question I not answered. CARO applicability. What is that? Internal audit 138. Just give me a minute. I'm not able to get on to my earlier presentations. During the amendment time, we had mentioned that it is there, or else. No, so probably you could send me a mail on that internal audit limits are there. It's under 138, read with the company's accounts rules 2014. It is coming in 138, this chapter 9. These are not, you have repeated that question, CARO and IFC. Is someone asking a question?
No, sir. Naresh joined a different device.
Okay, so I think I've answered all the questions,
yes,
except the one doubt on the fixed deposits were to be included under the financial assets as per RBI, this thing, plus the internal audit limits. I will internal audit, whoever has asked a question, I request sir to just shoot a mail. I'll share that limit tomorrow.
Yes,
it's back to you. If Delhi sir is there, Naresh sir is
here. Naresh sir, over to you, sir.
Thank you so much once again. Thank you all the participants for staying relevant. We had a wonderful learning session, almost 8:15. We started at 5:30, so almost 2.5 hours.
Naresh sir, are we audible, sir?
Yeah. Yes, sir. Am I audible?
Yes, sir, you're audible, sir.
Yes, quite very much.
Yeah. So Jomon sir, your presentation was excellent and a lot of points even useful for me. Though I'm completed one PSU audit, I'm still learning a lot from every point that was being discussed. Thank you very much. In fact, we had crossed 1,000. We had crossed 1,000 logins today. We hardly started about 1 week back. That shows a lot of members are keen on updating their knowledge on CARO 2020, which is being anyway effective for this year. So that's very nice of all the members who have registered, and also thank you for sparing your time and your eagerness to share your knowledge. It was very useful for all the members. On behalf of all the members present and also on behalf of SIRC, I thank you for sparing your time and addressing the members and sharing your rich knowledge on the company law, Schedule 3 and CARO 2020. Thank you very much, sir.
Thank you so much. Honored.
Thank you.
I leave Selva. Thank you,
Yes, sir.
members.
Thank
We
you.
still have 560 online with us. Thank you so much. Let's continue to interact. My pleasure to do that. Thank you so much.
Thank you, sir.
Sir. Bye-bye.
Thank you, sir.
Excellent job. Seamless, Selva. Keep going. You are a big support, IT support for all our programs. Thank you so much.
Thank you, sir.
You invited me for a test drive this afternoon and it was successful.
Thank you, sir. Thank you.
Thank you, Silva. Bye.
Thank you, everyone. Bye.